are now live.
Thank you, Modesto. I'm not sure how much of the beginning was captured because of Channel 64's technical challenges. So I will begin, as I started earlier, this Committee on Finance. Today's Monday, December 13th, regarding Bill number 210956. I understand that state law currently requires that the following announcement be made at the beginning of every remote public hearing as follows. Due to the current public health emergency, City Council committees are currently meeting remotely. We are using Microsoft Teams to make these remote hearings possible. Instructions for how the public may view and offer public testimony at public hearings of council committees are included in the public hearing notices that are published in the Daily News, Inquirer, and Legal Intelligentsia prior to the hearings, and can also be found on phlcouncil.com. I know that the hour has come to begin this hearing. Mr. Iannusa, will you please call the roll, take attendance? Members that are in attendance, will you please indicate that you are present when your name is called? Also, please say a few brief words when responding so that your image will be displayed on screen when you speak.
Councilmember Cindy Bass.
Good morning, Mr. Chairman and colleagues. I am present. Thank you.
Councilmember Alan Dom.
Good morning, Mr. Chair and colleagues. I am present also.
Councilmember Helen Gim.
Good morning, Mr. Chair. Good morning, colleagues. I am present, but due to the condition of my voice, I may be asking some of my colleagues to ask my questions for me, but glad to be here. Thank you for your work.
Councilmember Curtis Jones Jr.
Good morning, Mr. Chair, members of the committee, and those who are here to testify in Philadelphia.
Councilmember David O.
Good morning, Mr. Chairman and colleagues. I am present.
Councilmember Mark Squilla.
Good morning, Mr. Chairman and colleagues. Present.
And Chair Derek Green.
I am present. Good morning. I want to thank all my colleagues for being here for this Finance Committee hearing. A quorum of the committee is present and the hearing is now called to order. This is a public hearing on the Committee on Finance regarding Bill number 210956. Mr. Iannusa, will you please read the title of the bill?
Bill number 210956, an ordinance signifying the intention of the City of Philadelphia to organize the Philadelphia Public Financial Authority pursuant to authority established under state law and amending chapters 2600, Standards of Conduct and Ethics, 201200, Lobbying, and 171400, Non-Competitively Bid Contracts Financial Assistance of the Philadelphia Code to address ethics, contractual, and other requirements applicable to the Philadelphia Public Financial Authority, all under certain terms and conditions.
Before we begin to hear testimony from the witnesses we have here for today, everyone who has been invited to the meeting to testify should be aware that this public hearing and meeting is being recorded. Because the hearing is public, participants and viewers have no reasonable expectation of privacy. By continuing to be in this meeting, you are consenting to being recorded. Additionally, and prior to recognizing members with questions or comments they have for witnesses, I will note for the record at this time that we will use the chat feature available in Microsoft Teams to allow members to signify that they wish to be recognized in order to comply with the Sunshine Act. The chat feature must only be used for this purpose. As we begin this hearing, I just want to take a few moments to thank all of the various parties who've helped in crafting this legislation on the hearing today, who are witnesses, who are participating in this hearing. And we began the conversation really with just a discussion that I had with representatives from the Philadelphia Public Bank Coalition, principally Stan Shapiro and Susan Wendell and Peter Winslow. And then after some research that I took about this whole concept of public banking, and it really took me back to my beginning of my career when I started as a small business lender for Meridian Bank and saw the real impact that lack of access to credit and other challenges impacted so many communities in the city of Philadelphia, especially those in moderate to low income, and in particular Black and Brown communities, and also other organizations that try to provide services and goods to citizens in the city of Philadelphia, but really actually had a real difficulty in getting access to credit, principally cooperatives, as well as nonprofit organizations, especially those in the development community. So from this initial conversation and hearings that we had in City Council, we're able to then work with former tech staff attorney Steve Masters, as well as students in Fell School of Government. And then we were able to identify some resources to bring in a national consulting group, HRNA, that helped us to put together a feasibility study for this idea of a public bank in the city of Philadelphia. As we continue to move forward and have additional conversations and meetings and discussions regarding this idea, we were then also able to identify dollars through our budget process to bring in outside counsel. And we were represented by various attorneys from Holland and Knight LLP, provided invaluable assistance to us as we continue to draft the bill that's before us today. In addition to the great work from Holland and Knight, we also worked with the members of the law department as well as the treasurer's office, who really provided regular and additional assistance to us as we drafted this bill. And this bill did not come out of a vacuum. We spent generally every Tuesday and Thursday morning at 9 a.m. talking about the various challenges and difficulties in getting this bill to this point. Also meeting with the Philadelphia Public Bank Coalition basically every other week to talk about this issue. And then we also had community engagement, where we had a monthly Facebook Live conversation with a number of different participants from the Accelerator Fund, from Mary Rose Martinez, as well as Emily Shapira from the Philadelphia Energy Authority and the Philadelphia Green Capital Corporation. We even talked with various people from around the country who were also looking at this idea of public banking, from Shaman Walton, the chair of the Board of Supervisors for San Francisco, to others all around the country about this idea of public bank, and even had 2 summits to talk about this issue. And so many people who are on this call, from Vanessa Lowe to Tim Brown to Beth Finn to all of the various individuals who are here, really helped to create this legislation. So this has been a collective approach with a lot of different constituencies, really trying to address a very complex and challenging issue. And how do we provide opportunities for businesses, especially in the city of Philadelphia, as well as other organizations, to give them an ability to get access to credit. And when you think about the issues we are dealing with in the city of Philadelphia, we all know we have a 25% poverty rate. The fact that we have an African American and Latinx population of 44 and 15%, but only 6% of the businesses in the city of Philadelphia are owned by African Americans, and only 4% of the businesses with employees in the city of Philadelphia are owned by those from the Latinx diaspora. This is an issue that is important and also ties directly into the unfortunate other stat that we have, which is 525 homicides in the city of Philadelphia. And when you look at the fact that we've had this gun violence issue in our city, we've had a significant amount of poverty in our city, and we see that Black and Brown communities, especially from the business perspective, are not able to grow. Anything that we can do to address this issue and provide additional opportunities to provide access to credit is important in order to move our city forward. And when we think about the opportunities on the horizon from the $1.2 trillion infrastructure bill, we want to find and use every advantage that we can to allow those businesses to be able to participate in that economic development opportunity to grow jobs in the city of Philadelphia, to help us address all the issues that we have just stated. So thank you all for your participation, your investment, your time, and your treasure in helping us to get to this point. to be able to get and have this hearing this morning. And Mr. Iannuzzi, will you please call the first witness we have to testify this morning regarding bill number 210956.
Rob DeBoe, Director of Finance for the City of Philadelphia.
Good morning, Chair Green and members of the committee. My name is Rob DeBoe. I'm the Director of Finance. I'm joined today by City Treasurer Jackie Dunn and First Deputy City Treasurer Natalia Dominguez Buckley. And we're here to testify on Bill number 210956, which would create the new Economic Development Authority, the Philadelphia Public Financial Authority. We want to thank the bill sponsor for identifying an important issue and putting forth this bill to move conversation on that issue forward. We resoundingly support the broad policy aims in the bill, particularly the focus on the challenges faced by Black and Latinx businesses who are denied conventional loans and seek access to capital to start and grow businesses. While we support the intent of the bill, we're not sure how it will address those important issues in ways that existing entities cannot. The city, for example, has an existing authority, PAID, and PIDC that are already resourced and offer financial services and resources to underserved communities across the city. PAID was created under the same statute and created the same powers as the proposed authority we're discussing today. Using those powers, PAID and PIDC affiliates carry out important work like the work outlined in this bill. In addition to PAID and PIDC, the city is also fortunate to be served by many community banks, credit unions, and CDFIs that provide access to capital for small businesses, as well as consulting services, trainings, and workshops for entrepreneurs and community developers. Working with these organizations may be a more effective way of accomplishing the goal of the legislation. It's also likely that the new authority would compete with these existing entities for financing, but we're not sure, based on the legislation, how the authority would be funded. There are several other areas where the intentions of the bill are unclear, including the following. The bill authorizes the new authority to issue debt. It's unclear, though, what revenues would be used to repay that debt, whether those debts would be financial obligations of the city that would then compete with other priorities of the city. And also, the bill contains language that would allow the authority to accept city and school district deposits if there's additional federal and state legislation in the future. Without this additional authorization, the authority cannot serve as a city depository. As city deposits fund the critical operations of all city departments, city payroll, and reserves to help the city navigate financial crises such as COVID-19, those funds must be collateralized to limit the risk and ensure they're available when needed. Those dollars are therefore unavailable for loans or other activities contemplated under the bill, and that gives us some significant concerns if the intent is to pursue depository status for the new authority. The bill also includes language regarding financing renewable energy and energy efficiency projects, affordable housing, and land trust. We'd like to understand better how that work is coordinated with existing entities. And finally, the bill gives the authority the power to buy and sell securities and property. And while there may be no intention to do that immediately, we have some concerns about what that would mean, and what kind of risk that would create in the future for the authority and potentially the city. So we hope these questions help further the conversation about how to best to achieve the goals of the legislation, and we're available to answer any questions you may have.
Thank you, Mr. DeBoe. I know that we have questions, and I'll tee up the questions for Councilmember Jones and Councilmember O. You had stated some concern in reference to the concern of conflict or competition. Can you provide some more perspective to that?
Yeah, so I think a lot of the powers that this entity would have are powers that, for example, PIDC already has. And so there are functions that could be carried out by PIDC. But, all those functions require resources. So the concern is that this authority and PIDC or CDFIs, because the legislation also would enable the authority to apply for CDFI status, would be competing for similar resources.
And so but we provide resource and provide assistance to a number of different CDFIs around the city, correct?
That's correct.
So even though we have multiple CDFIs that we support, we don't not support them because we think they may compete with each other, correct?
Correct, but each new entity we add adds to the competition for dollars.
Right, but we also, there are a number of entities that we provide resources to from a diverse perspective that you can say are competing for dollars. In fact, we go through a budget process every spring where you can say there's a competition of dollars, and we make prioritization and decide how we allocate those dollars based on needs and things that are not being addressed in the city.
That's right, and this would just add another entity competing for those dollars.
Right, it would be basically another entity addressing an issue that's currently not being addressed currently, because you would agree with the statistics I provided that we have a significant problem in the city of Philadelphia, and I'll focus on businesses where African American and Latinx businesses are significantly not been able to grow in the city of Philadelphia.
Yes, we agree that that's an essential issue, but we do think that there are entities that are empowered to address those issues. And we also think, and I think when Ann Evans testifies, she'll talk about this in more depth, that PDC has actually shifted its focus over the years to have more of a focus on the very issues you're talking about.
But even though those entities may have been empowered, saying PIDC has shifted to provide additional support, when you think of the historical inequities and just a nagging poverty issue, I would think it would make more sense to have as many organizations as possible to help address those issues.
Unless they cannibalize each other's activities, which is what we're concerned about.
Well, that's also an assumption, but just like we have other organizations that work collectively and partner with each other, its ability to grow as opposed to cannibalization.
Yep, and I think the entities that already exist also have the ability to grow and provide some of the exact same services you're talking about.
Right, and so when you say provide some of the same services, we want to make sure that we reduce the amount of risk that these organizations take as they try to help businesses, correct?
Correct.
So, and Rob, have you spent time in your career as a lender in the past?
I've not been a lender.
Okay, so one of the perspectives, I know it's been some time, but having been a lender, one of the issues is you try to mitigate risk, and the fact that PIDC can now provide additional loan guarantees. Traditionally, from a lending perspective, you want to make sure that the same entity that's providing the guarantee is not also providing the loan. So to have the ability of an entity that can provide a guarantee separate and apart than the actual entity providing the loan helps to spread the risk and help to better provide the resources that are needed to address these issues. So in fact, what this entity would do would help PIDC do more, so we have less resources being tied up into credit enhancements and guarantees, and actually free them up to do more lending to the same areas that are what we're talking about.
The bill, though, gives this authority power to do many more things than just guarantee loans. If that's all it was doing, that would be different from what this legislation is proposing.
Right, and basically, when, as you've known, that when you draft legislation, you try to look at all the possibilities where an entity could grow into the future, as well as partner with existing entities, because we don't want to limit the ability of entity to do more things as things change and transition into the future. I think we all can relate the fact that we're actually having this conversation via Microsoft Teams, via the internet. If this was the early 90s, we would not have the same ability to do so. So I think we want to make sure that we have products and organizations that are flexible to grow and address issues as we move forward in time.
Yeah, and I guess our concern is if they do those other things and wind up competing with other entities, that's the issue we're raising.
Right, and that's based, and I understand the concern, but at the same point, we can't predict the future. Just like none of us would have predicted we'd be on Microsoft Teams or have a global pandemic. We also can't predict that they would compete. We also could just as easily say that they could partner and work collaboratively together to help both organizations, as well as credit unions, CDFIs, and other institutions that are trying to address the issue of access to credit for businesses, especially in the city of Philadelphia, considering this has been a historical, systemic issue in our city. I take your pause as an agreement with my
Well, my
assessment.
pause
I
was,
recognize Councilmember Jones.
okay.
Councilmember Jones, I
You're
believe you
muted.
are on mute. Councilmember Jones, I believe you're on mute. There you
Yeah,
go.
I have it now, Mr. Chairman. I would have hated to seen you come in the courtroom back when you were handling your prosecutory business.
We're just having polite conversation. That's
Yeah, I
all.
know. It
Yes.
was good. It was good. It was stimulating. I want to start by saying I was the former president and CEO of the Philadelphia Commercial Development Corporation, which did millions of dollars of lending, and I was a lender to small businesses around the city of Philadelphia, many of whom actually paid the money back, many of whom are still around today. And one of the most rewarding parts of my professional career. Currently, I am on the executive board of the Philadelphia Industrial Development Corporation, which is the primary funding for small businesses intensified in Philadelphia. And having those experiences, I can tell you that demand far exceeds the supply for capital in the inner city in Philadelphia. Can guarantee you that. Granted, PIDC is not our grandfathers. PIDC, they're doing more deeper dives into Black and brown businesses. I am proud to serve on that board, but it is going in the right direction, but not quick enough and not enough. So to me, the argument being made is like saying, why would we want Chick-fil-A when we have McDonald's? Well, there's enough demand to go around for both Chick-fil-A and McDonald's, and each of them have their consumer preferences and particular areas that they go into. So depending on the anatomy of what this public financing institution will be, there is plenty of room in the marketplace, in my opinion, for that. I think whether we're talking about private capital, federal capital, state capital, that we are at a point in our society where we understand the need for more sensitive lending, more access to capital, and I think that this might be some of those answers. So the question for me is, Mr. DeBow, if you had your preference of how you would structure this entity, trying to safeguard and minimize risk to the city, how would you recommend that we look at this future entity, if you have any opinion on that?
Yeah, so I mean, I think you won't be surprised. I would want to see it have as much outside financing as possible, other than the city. And to the extent that if the chair is saying that the real benefit is that it could provide guarantees for loans, for example, by PADC, that seems like a good function for it to be able to provide.
So in the case of PCDC and PIDC, it is a hybrid of a nonprofit where you have board members that act as board members to kind of examine, reevaluate, and look at the performance of the entity. Do you recommend what type of structured leadership in this entity would you recommend or feel comfortable with?
So the legislation lays out a board and a policy board, and it lays out requirements, including appropriate knowledge of the area. I don't have any issues with the board as it's set up.
So you don't have a problem, or you are neutral to how the city might set up this particular board, do not have any particular insights, suggestions, recommendations in that regard?
I don't have any changes to the proposal in the legislation.
Okay. All right. So, Mr. Chairman, how do you visualize, and first of all, thank you for raising this to a point where we have it today, where it is being considered by council to become law. But help me to further understand how we should, and at what level should we capitalize this entity?
Well, thank you, Councilmember Jones, and also I want to thank Mr. DeBoe. I'm someone that tries not to reinvent the wheel, and I understand the concerns that he's raised. Others have raised that same concern in reference to competing dollars. This legislation was drafted from the perspective of not only economic development finance law from the Commonwealth of Pennsylvania, but also talking with a good friend of mine who is the head of the CDFI fund for U.S. Treasury to be able to enable this entity to receive private dollars outside of the city of Philadelphia. And by it being drafted, excuse me, in a way that can allow it to get CDFI status, that will enable private entities, private banks in particular, who want CRA credit to make investments into this entity that can allow it to raise additional capital. When we think about the Neighborhood Preservation Initiative that we supported, that was a $400 million bond initiative with about a $20 million annual debt expense for that bond. We're in the process of evaluating what would be the real operational capacity for this new entity. When you look at both the Philadelphia Green Capital Corporation as well as the Accelerator Fund, both of those entities started with about $2 million in initial operating dollars, which gave them about 3 years of runway to get their organization started. But from a capitalization perspective, we're in the process of making that evaluation. But even if we did look at a capitalization of say maybe 50 million or 100 million, you're talking about maybe $5 or $2.5 million in debt service on an annual basis. And to me, that's an investment in trying to help grow businesses from 6% or 4% to a much larger percentage of businesses with employees that can hire and create jobs and help to address our poverty level in our city.
I'd be interested, Mr. Chair, in hearing the testimony of your witnesses, but I'd like us to also establish what is acceptable risk. If we're going to be an entity that is as conservative as some of the banks, kind of what's the point? And I'm sure I need some insight about that. And then what steps we will take and consider by way of collateral, debt to equity ratios, things like that, so that we can understand, how we can be of more assistance. That it does not presuppose that all Black and brown businesses have poor credit, because that is not the case. But how can we allow for a earlier entrance into small business than traditional lending institutions allow? So I'll be listening for that, Mr. Chair.
And thank you, Councilmember Jones. And we spent a lot of time getting through the regulatory challenges, getting the legislation to this point through our conversations with Secretary Vague from the Pennsylvania Department of banking and securities and his staff, from the conversation with City Controller, a whole host of others. And we're also looking at the capitalization aspects as we speak. And so we're working through that. The goal would be to move this bill out of the Finance Committee hearing today, and then we will have the calendar for next year so we can work through these additional issues and get to that perspective. But I'll leave you with this, and then I'll call on Councilmember O to be followed by Councilmember Dom. When I look at the need for this legislation, and we think about a small business that, say, has a $250,000 line of credit with one of our existing CDFIs from Panata Vested In, and they may have a deposit relation with our existing bank. Let's say it could be a Wells Fargo or a Santander, or maybe even a credit union like Federal Credit Union. And now, because of the infrastructure bill, this business now needs to grow. They need to increase their cash flow, but they don't have a lending relationship with those other major institutions. They just have a deposit relationship. With the CDFI, where they have a line of credit, that CDFI may not be able to do a line or a loan much higher than what they currently have. So they end up being stuck because they don't have the friends and relatives and others who can then provide the guarantee to allow them to get a larger loan with that large institution. They have not had that lending track record of having a loan over $500,000. Over $250,000. And so what it causes this situation is this historical scenario where the mainstream banks do not want to take that type of additional risk because, one, they've not had that lending relationship with that small business, and two, that small business does not have the collateral or the risk mitigation to say, yes, you can do this loan. And so what happens is that a lot of our small businesses tend to stay at that level of not being able to grow. And so we always talk about when it's either the Eagle Stadium or Phillies or now the infrastructure bill would provide opportunities to Black and brown businesses. So they may get the opportunity by getting that bid or being awarded that bid, but because they don't have the ability to increase their lending to address the cash flow, to allow them to hire more employees, they never get the opportunity. And so this happens over and over and over again. And we spend a lot of time on economic opportunity plans, providing the ability or trying to create a pathway for someone to get the work, but they never get the financing that they need to do the work. And so that's become a very cyclical issue. And so by having this entity, it can fill that role of addressing the collateral concerns and reduce that risk to make them more attractive for those institutions in order to grow. But that's not just for Black and brown businesses. We have other hard to lend to entities like cooperatives, where you have multiple people that own that organization, but not one person is providing that guarantee to enable them to get a larger loan they're trying to expand. Or our affordable housing developers who may not have a long asset or balance sheet because most of their resources are tied into trying to do development. That's why I see this entity initially trying to address that issue.
So, Mr. Chairman, I want to just listen to some of the other people to testify, but I will say in my decade of work at PCDC, one of the programs and lending products that I was most proud of was accounts receivable financing, which allowed small companies to take advantage of city contracts by providing them upfront working capital secured by the contract with the city. So there was a copay on the contract, which we had less than 1% loss in that. We had one person who forged a signature on a copay check and got away with it pretty much. But other than that, hundreds of financings occurred successfully, allowing female and minority businesses to partake of procurement opportunities with the city. So I'm looking forward to this discussion, Mr. Chairman. Thank you.
Thank you, Councilmember Jones. Councilmember O to be followed by Councilmember Dunn.
Thank you very much, Chairman. My questions are for the Finance Director, Rod DeBoe, but I will say, Chairman, that you are quite knowledgeable, and I certainly welcome your, comments because I do have my concerns, and I'm going to ask a couple questions. However, I will also say that I appreciate the effort that you've made, clearly very serious efforts in addressing this problem in a very innovative way. I'm going to also lay out just a little bit about, my perspective. So I served on the board of First Commercial Bank of Philadelphia, which addressed this problem along with some other banks at a time where the issue of banking and whether or not banks were knowledgeable enough about, in particular, minority businesses and women-owned businesses and ethnic businesses and immigrant businesses. When I say knowledgeable enough, in other words, whether they wanted that to make those loans and whether or not they understood that they would not lose money. Of course, they don't want to lose money. The issue that I kind of look at is the fact that there are many different groups of people in our city and in our country that have self-lending systems, but whether it's people from Africa, Jamaica, the Caribbean, Asia, they lend money to themselves. However, they eventually run into a limitation and they need a commercial loan. The problem is they were not able to, many times because they didn't have a language ability or culture, or they recently got here, or they just started the business. They didn't have the documentation to show that they were credit worthy. And so a bank like First Commercial Bank, which focused on that market and other markets like it, would study the issue, give them a loan, which is typically a smaller loan, but a lot more than they could get from a money lending club or group. But the interest rate was higher. And after they established themselves and were able to pay back the loan and get credit enough to go to a larger institution, they would leave the small bank to go to the large institution because the interest rates were lower. And so, the issue that I'm going to kind of focus on is not whether this is a worthy effort or not. It's just really just around the legalities and practicalities of a municipal banking entity. My understanding is that state law prohibits the city from establishing a bank, and therefore a bank, a lending type authority, is something that this ordinance is looking to do. So there is a law, and you were talking about, Chairman, you were talking about talking to the Secretary, I think, of Banking, and I'm sure you've spoken to others. But I'll start with Rob DeBow, and perhaps, if he doesn't know the answer, you could answer for him. So under the Pennsylvania Economic Development Financing Law, which is the law that is being, as proposed for the Philadelphia Public Financial Authority, it requires that all deposits be with banks and trust companies, and requires the deposits to be continuously secured by pledges of federal or state obligations of at least equal value. Is that something that is being worked on for this Philadelphia Public Financial Authority? I mean, legislatively speaking, is that an issue or is that not an issue?
If you're asking whether it's being worked on, I think I'll defer to the chair on that, because he'll have better information about what work is being done with the state and feds.
So just to, and we have both our counsel Holland Knight on, as well as the law department, but I'll answer the question. We've had numerous conversations with the Pennsylvania Department of Banking Securities in reference to the bill that's been laid out for today. Their perspective is that what we are trying to do is available and is legal under the laws of the Commonwealth of Pennsylvania. Their principal concern was if we use the word bank in the language of this legislation, but they also stated that they would be willing to talk about the issue and how we can work collectively on creating a bank charter for the purposes of this goal. So we've had numerous conversations with them in this regard regarding the legislation, as well as it being reviewed both by the city law department as well as Holland Knight, our outside counsel.
Thank you, Chairman. Would that include the ability to supervise and regulate the Philadelphia entity, the financial entity? My understanding is currently under state law, any proposal to establish a public bank it is currently prohibited that the city supervise or regulate such a Philadelphia bank.
Well, first of all, this is an entity, it's a municipal authority, much like the Philadelphia Energy Authority, much like we've also talked about PIDC and PAID, which also are quasi-entities from the perspective they're joint entities of both the city as well as the Greater Philadelphia Chamber of Commerce. So the fact this is a municipal authority, it's a separate entity than the city of Philadelphia itself.
But this entity does direct retail banking, I believe. Does it lend to? No, it doesn't.
No, this entity would not be doing any or receiving any type of retail deposits or deposits from commercial customers. It would be similar to many other entities within the Commonwealth of Pennsylvania that have been empowered by the Economic Development Finance Law to provide this type of product and service.
Is this, in that case, I know you touched on capitalization. Where does it get its capital from?
So from a capitalization perspective, we're looking at a couple things. One, working with the city, and there's various ways we could look at that. But just like with the Neighbor Preservation Initiative, just like other initiatives that we've done where the cities help provide resources, or even with the Accelerator Fund, which received initial capitalization from city-related entities as well.
So when I think about the North Dakota Bank, it's a $3.9 billion loan portfolio, most accurately described as a bank for banks. Is this kind of what you're doing, or is it something different than that?
That actually is a good model. I mean, this is the first of its kind in the Commonwealth of Pennsylvania and also the nation. So we're looking at multiple different avenues. So the Bank of North Dakota as a banker's bank is something that I can see very similar in reference to what we do with this entity. Just like PIDC has a CDFI, there are other CDFIs. Some of those entities themselves would like to get access to additional credit, but they may not be able to do so as well. So having an entity like this Philadelphia Public Financial Authority could also provide and help those organizations to do more lending as well and partner with them. So that's why really the goal of this entity is to partner with multiple institutions and do what they don't do. Many lenders are not focused or engaged in the area of providing access to credit from a credit enhancement perspective. And so that's why this is fitting a need and a void that most other lenders do not do from a whole host of issues and areas.
Last question, and I guess, Chairman, you're going to answer this, but Rob, are you listening?
I am.
Okay. We might get an answer from you, I'm not sure, but I kind of don't think you have an answer for this. But my question is, considering the a kind of history of the effort of public banks and the unsuccessful history, I know that San Francisco recently conducted a study of public banking and estimated that it needed an investment of at least $184 million up to $3.9 billion to operate a public bank. Is that a concern? Do you find that to be relative to Philadelphia, or is that, or are there lessons learned from that study? What do you think about that?
Well, and you know, although my friend Shemai Walter is not on the call today because it's much earlier in San Francisco than it is here, but San Francisco and Philadelphia are much different. They are a city that's less than, I believe, 900,000 residents, and they have a budget about $9.9 billion. City of Philadelphia is a 1.6 million resident population with a budget of about 5.2 billion. They took a process of putting together a commission to address issues in San Francisco and address the idea of public banking. Also, at the state level, the state of California has provided enabling legislation in order for public banks to be created in California. I have not had a chance to talk with Supervisor Walton on the various details of their public bank initiative as of late. I'm not sure if the state of California is making an investment into that public bank. Also, they may be doing a public bank that may provide resources for those outside of the city of San Francisco. They have not drafted their legislation as of yet. They've done a study and have been working on a working group on a lot of different issues. So they're in a kind of different perspective than we are. When we initially brought in HRNA to do a feasibility study regarding the whole concept of a public bank, and one of the reasons why we took this route of creating a municipal authority was based on some of the issues and concerns that have been raised today, that we do have a different system than other states, different than North Dakota, different than California. So we had to craft legislation based on the existing laws within the Commonwealth of Pennsylvania. That's why we've had the conversation with the Federal Reserve of Philadelphia, or Secretary Vague, or Jody Harris, who's the head of the CDFI fund for the U.S. Treasury, or people at DCED, because of these issues and concerns, to put something that fits and makes sense for the city of Philadelphia, but really allows us to really address the issue and the concern, which is providing resources to address the issue of the lack of access to credit for so many of our small as well as Black and brown businesses.
Excellent answers, Rob. Thank you so very much. No, in all seriousness, I will say, while I do have concerns, I certainly have been very impressed, Chairman, with your thorough, going through everything, talking to everybody, being on top of everything. So I do feel pretty good about your exploration of everything, and so I too, like Councilmember Jones, I'm going to sit back and listen and see what else is brewing, and I appreciate all your hard work and everybody's work as well. Thank you.
Thank you, Councilmember O. And as someone that spends a lot of time on a lot of these issues, I'm appreciative of the questions that you're raising, as well as Councilmember Jones, because we do need to kick the tires and ask these questions, because there may be areas that I or others of this team may have not thought about. And I appreciate the concerns and questions raised by our Finance Director DeBow as well, to make sure that we have the best product that addresses the issues and concerns for the citizens in the city of Philadelphia. Councilmember Allen Dodd.
Thank you, Mr. Chairman. I want to start off by thanking you, Chairman Green, and the co-sponsors of this bill for really bringing this important conversation about how we support our current and future Black and brown business owners in the city of Philadelphia. We're at the bottom of Black and brown business formation on the East Coast, the bottom, and we need to do something about it. And so this is a good start. I've spent a good deal of my time, talking with minority business owners over the years about how we can make it easier for them to start and grow their business in our city. Access to capital is always in the top 3 list as we know it. And it's partly due to issues of systemic racism in many markets, including the banking industry. But because of decades of racist practices, minority business owners have had vast differences between friends and family lists when starting a business and looking for seed funding. So I very much appreciate the intent of this legislation and all it seeks to do, especially for communities of color. My concerns today are not related to support for the intent. I support the intent. But it's regarding the details for how we implement this idea of a financial authority. So first, and foremost, because I've been listening now, I think it's important for us to distinguish between what a public bank is and does versus what we're discussing today, which I believe is a financial authority. So I'd like to ask the finance director or you, Chairman Green, to put on the record those differences so the general public understands what we're talking about today. Thank you.
Would you like me to start and allow my co-counsel to start?
Either one.
So let me just kind of take everyone through the path. I initially talked about how we did the feasibility study with HRNA in reference to how do we craft the ability to address this issue. So the first step was looking at the Economic Development Finance Law, which is the entity that was used to create some of the other economic development entities we talked about. Under that law, it allowed us to provide the type of products we're talking about in a separate municipal authority entity. In addition, want to see how can we find ways to raise dollars for this entity beyond just the city of Philadelphia. And that's why we crafted it by making it be able to qualify as a CDFI or Community Development Financial Institution. In order to be a CDFI, we had to marry two different distinct issues. Under the Economic Development Finance Law, it provides certain appointment powers that are required under the Commonwealth of Pennsylvania. In order to be a CDFI, you have to demonstrate separation from control from the public sector. And that's why this entity in the legislation has two different boards. We have the corporate board, and then the corporate board, once it's appointed, they will then appoint a policy board. Both those boards have to have certain qualifications. And by drafting it this way, allows us to not only qualify under the Economic Development Finance Law, but also then qualify as a CDFI. Now, the third step would be from the conversation we had with the Department of Banking and Securities of how this entity could be a public bank in order to just receive and hold deposits from the city of Philadelphia. So those are the three steps. But even in that third step would entail us having to receive a charter from the Commonwealth of Pennsylvania, as well as address some of the collateralization issues that are required under state law, some of the issues at the local level we could amend by legislation. But those are kind of the three steps that would occur in this process, which would happen over the period of time.
Rob DeBell, you want to add to that, or are you good with that analysis?
I'm good with that analysis.
Rob, I'll send you the bill.
So let me just ask a question. I just want to make sure I'm clear. It sounds like it's not a public bank yet. It's a really a public financial authority in order to accomplish the goals, which you couldn't accomplish them initially by being a public bank. Is that accurate?
Well, we could not call it a public bank based on language or conversation, Department of Banking and Securities, because the entity does not have a bank charter. And there's a process to do that. And in our conversation with the staff, Department of Banking and Securities, they stated very specifically why we could not use the term, but also was very encouraging on how we could work in that process in that regard to achieve our goals.
Okay, and I know you mentioned Secretary Bank, Richard Vague. Has he weighed in on this idea, and what are his thoughts?
I've talked with him a couple different times. I've known him prior to him becoming secretary. He also has a banking background as well, so he's very knowledgeable of the concern we're trying to address. He, in our conversations, also deferred to his staff, who are the ones who are the technical. Should I say, are the experts in reference to both the banking code from the Commonwealth of Pennsylvania, and it was in those conversations how we helped to craft the legislation that's before us today.
And how about our city controller, Rebecca Reinhardt? Have we weighed in with her, and what are her thoughts on this?
We've also had conversation with City Controller Reinhardt in reference to various dynamics of this legislation as well, and have included her participation, and will continue to do so going forward.
Is she supportive of this, and is Secretary Vague supportive? Do you know?
They both. I can't speak for them. I think I will say that they both acknowledge the issue we're trying to address. In reference to the issue of access to credit for Black and brown businesses.
Okay, thank you. My question now is for Rob. Rob, you mentioned that you were concerned about diverting the money, I guess, to this authority. So who would be losing the deposits, in your opinion? Like, what is the concern that you have?
So are you talking about specifically if the federal and state governments allow us to take deposits from the city?
Yes, yeah.
Okay, yeah. So the concern there is that, our funds are really for specific uses. If we lose money, for example, then, we still have to make payroll. We still have to pay all our bills. So we would be really concerned if that money was being used to make loans that could then default. And I don't know whether Jackie or Natalia want to add anything to that, but that's...
Point of information, we currently provide city deposits to institutions that also do lending of dollars as well. So the concern that you raise could also be mitigated with a public bank, just like a Citizens Bank or Santander or Wells Fargo have had city deposits that are segregated than the resource they're using for other type of products. This public bank, if it got to the point, and assuming it got to the point of receiving a bank charter, would be no different than a Wells Fargo or Santander, where certain deposits were segregated than the other dollars that they provided. And to be quite honest, those dollars are not necessarily segregated per se, because often dollars are in a sweep or a sweep account where dollars are reinvested overnight. So those, I don't want to get too technical, but the same structure that traditional multinational banks have in receiving municipal deposits is the same structure that can be used for a public bank.
So those deposits have to be collateralized. If the public bank was directly making loans with city money, we wouldn't have that same protection.
Well, there's various ways that can be structured. I don't want to get into the details because that would take us down a rabbit path that I'm not sure most of the 31 attendees would enjoy.
Okay, but that's our concern. You asked Council Member Don what our concern is. That's it.
It can be mitigated. Okay.
Thank you. Chairman Green, is it possible we can get a formal opinion from the controller? It seems to me to be important to get an opinion from her, certifying our debt capacity and even potentially, because she sits on, I guess, the pension board and the bond committee, just to make sure that she's on board with this.
I'm not aware of the controller's office issuing a formal opinion like the law department does to a solicitor's opinion, but I can, get her to weigh in. But I think, based on the legislation that's drafted and, we're still working through the capitalization perspective, maybe difficult, can't speak for her, but that may be difficult for her to issue an opinion in a form that I've not seen issued in the past, but we can ask the question.
Okay. One other question I had for you. We talked about this yesterday, and by the way, thank you for your time yesterday on a Sunday talking about this. So is there still an idea out there that we could go to our 16 largest banks and utilize them, as we talked yesterday, to maybe be a funding source for this, and share with us how you think that could work? Because that would really limit our downside by using their money to do this lending.
Well, that's why this was structured as a CDFI entity, because for most banks, if they're not getting CRA credit, they're going to use that for, they're going to want some return in reference to that investment. Other than their foundation or other dynamics, traditionally banks don't make those type of major investments unless one is being going through their foundation where they're getting some type of benefit from that end or getting CRA credit. And so that's why we drafted this from a CDFI fund perspective. Other type of investments traditionally banks have done have been from a lending or reduced lending type of dynamic, which puts us into the same issue of the underwriting that we have a concern in reference to the businesses that can't get access to credit because they don't have the collateral.
Right. Okay, I don't have any further questions at this time. I thank you. You've done a lot of work on this, and I appreciate it. And I think the idea is good, and I think we just have to make sure, the old Ben Franklin comment of, I'm not as concerned about the return on my principal as I am concerned about the return of my principal. And if we can cover that, I think everybody's going to be good. So thank you very much, Mr. Chair.
Thank you, Councilmember Dom. Let me just check to make sure there's no additional questions for this witness. Seeing none, thank you, Mr. DeBow.
Thank you.
Mr. Inuz, if you could read the next the names of the witnesses for our next panel.
Regina Hairston, President and CEO of the African American Chamber of Commerce of Pennsylvania, New Jersey, and Delaware. Ann Bovair Nevins, President of Philadelphia Industrial Development Corporation. Leslie Smallwood Lewis, co-owner of Mosaic Development Partners, LLC. And because she needs to leave before 11:30, I believe Britt Alston may need to join this panel as well, Mr. Chair.
Okay. Thank you. Please proceed with your testimony.
Good morning, Chairman Green and members of the Committee on Finance. My name is Regina A. Hairston, President and CEO of the African American Chamber of Commerce for Pennsylvania, New Jersey, and Delaware. And I am here today to share the barriers our members face accessing affordable credit as it relates to Bill number 210956, authorizing the creation of the Philadelphia Public Finance Authority. Historically, access to affordable credit and capital has been and remains the number one barrier for Black entrepreneurs to grow their businesses. Business owners and entrepreneurs need access to a variety of credit sources. Short-term credit matters for the day-to-day management of cash flow, while long-term credit is essential for capital investments. Yet less than half of small businesses report that their credit needs are met, according to the U.S. Small Business Association. According to the U.S. Department of Commerce, minority-owned businesses are more likely to forego applying for loans for fear of rejection, less likely to receive them when they do apply, and more likely to pay higher interest rates on business loans compared to their non-minority counterparts. A U.S. Federal Reserve study found that Black entrepreneurs were denied loans nearly twice as often as white business owners. But the track records of minority-owned businesses don't support the reluctance to invest. In fact, according to that same Commerce Department report, minority-owned businesses drive the creation of well-paying jobs, serve as anchors in their communities, and grow faster than non-minority-owned businesses. Given these pre-existing conditions suffered by Black-owned businesses, they closed at a faster rate in 2020 than white-owned businesses and were last in line to receive critical PPP loans and helped other businesses stay afloat during the early months of COVID-19. Black and brown businesses were disproportionately impacted by the economic crises. As a result, AACC collaborated with its partners to ensure businesses were connected to resources, information, and and recovery grants that would help open businesses stay afloat. AACC works closely with the City of Philadelphia's Commerce Department, PIDC, Area Community Development, financial institutions, Small Business Administration, United Bank, and other lending institutions to ensure Black owners have access to credit. In addition, we launched a Coach into Capital program to help solve the access to credit and capital problem that was highlighted by the pandemic. The Coach into Capital program is a one-year program that provides members with hands-on training, coaching, and a banker advisor to prepare members to access commercial lending. This program is in collaboration with several key partners, including PIDC and Community College of Philadelphia. Yet our efforts are still not enough. Small Black businesses continue to fail due to lack of access to credit. In January 2020, soul food restaurant Franny Nick's opened its doors in South Philadelphia, and just shy of her one-year anniversary is now closed. The owner has been unable to sustain the business with her personal savings. She did not qualify for many of the relief funding, and her attempts for credit approval continue to be denied. Philadelphia has the lowest number of Black-owned businesses per capita than other big East Coast cities, having 1.8 firms per 1,000 residents. We cannot afford to lose another small Black-owned business due to the lack of credit or lack of capital. AACC supports the City Council in its efforts to find solutions and leverage existing partnerships to address the access to capital barrier. Thank you for the opportunity to testify.
Thank you, Ms. Hairston. I know we have a tight panel, a few other people that need to leave early. So real quickly, if we can go to Leslie Smallwood Lewis, Britt Alston, and then we'll have Ms. Nevins conclude this panel.
Yes, good morning. Thank you, Councilman Derek Green. I'm here to testify on Bill number 210956. Some of you, I hope most of you, may know my company, Mosaic Development Partners. We've been in the city of Philadelphia, in our neighborhoods. Our office is located in Strawberry Mansion. We are a boutique real estate development firm, one of a few that are in the city of Philadelphia and have survived. We started our company in 2008 during the recession. We've been able to see ourselves clear through a pandemic. But all in all, that is because we have organizations in the city who have supported our company. So in the spirit, I completely support this bill and have had many conversations with Councilman Green about what the intention is and what and trying to support Black and brown businesses in the city. I will say that I just want to make sure that it in no way conflicts with the services that PIDC brings to bear. PIDC has been a full-time supporter of our company. We would not be where we are today without an organization like that supporting our efforts. They've been a part of, I think, almost every project. Sharswood Ridge, Eastern Lofts, Galassi Labs. They put forth a very aggressive RFP for the Navy Yard, really pushing for diverse ownership in the project, which then flows down and produces opportunities for Black and brown and female-owned companies, because we're at the table making those decisions and pushing that agenda. But I've had multiple conversations with Councilman Green, and I understand he is trying to address what we all know is a terrible problem. I also see, not just from the development perspective, but in most of our projects, we also try to support Black and brown businesses, and they struggle. They do not have the capital. They need the assistance with startup and fit out of their spaces. You know, they can't get loans. So it is an everyday struggle, which then bleeds down to the developer, because if you don't have strong tenants, then it's difficult for us to service our debt service for the project itself. So it is a domino effect, and one that needs to be supported throughout for all of us to be able to not just survive, but to thrive. So one of the things, I guess there's three things that I've talked to Commerce, Councilman Green, PIDC. It's lack of capital, and that's early capital. That's the higher risk capital. But we don't have family and friends where most of our counterparts, majority counterparts, have those relationships that can build them up and give them that strength out the gate to be able to bear some rough times and go after, projects and be able to feel secure and have a net that they can rely on, as they're trying to build their company. So lack of capital is a critical problem. Affordable capital. There are a lot of organizations that are in place, but a lot of the CDFIs also have to borrow those funds. So once they actually lend it to us as either the tenant or the developer, it is at a higher interest rate than traditional debt. But we're not capable of getting traditional debt. So this is absolutely all that we can rely on, thankfully, but it is definitely a challenge to our budgets, because we are now competing against majority firms that are getting loans, at 4% versus, 6 or 7%. And seed capital. Well, I think I mentioned seed capital, but the other thing is guarantees. If you're going and you're trying to build a relationship with a traditional bank, you have to have the strength of a balance sheet. You have to have either a captive guarantor. You have to have collateral that enables you to satisfy the requirements for such lending. And typically we don't have that. It takes us much longer to build our company, to build our balance sheet, to have the strength to actually borrow from a traditional bank. We are 14 years in, and we are now at a place where we are able to get traditional lending from a bank. But that actually took us 12 years, and most businesses don't survive past 3 to 5. So we are one of the few I think the city could qualify as a success story, but it has been a challenge. One that not every company that's coming behind us should have this same challenge. So in the spirit, I fully support it. Obviously, it needs to be completely vetted to make sure that it does not injure an entity like PIDC, who has been out there, in the trenches with companies that look like ours. But if there is a way for it to be collaborative, supportive, and provide more expansive resources to businesses like my own, I would love to see something like this to move forward. Thank you.
Thank you, Ms. Smallwood Lewis, Ms. Alston, and then Ms. Nevins.
Good morning, Chair Green and members of the Finance Committee. My name is Brittany Alston, and I'm a Deputy Research Director with the Action Center on Race and the Economy. We provide research to grassroots groups at the intersection of Wall Street accountability and racial justice. So I'm extremely excited to be talking with you all on this panel today. I'm also speaking as a former impact analyst at a community development financial institution. I will say CDFI because that is a mouthful. So thank you for holding the hearing. I would like to just walk through 3 points today for my testimony. One, I think a public bank in its final form for the city would present a public alternative to big banks whose racist and predatory practices have really had a profound impact on low-income Black and Brown residents throughout the city. 2, public banking can expand access to the unbanked and underbanked in the city. And 3, I think this is a great step toward a chartered public bank for the city. So big banks have had a long history of predatory and racist policies here in Philadelphia. In September 2016, Wells Fargo was issued a combined total of $185 million in fines for creating over 3.5 million fraudulent checking and savings accounts and credit cards that customers never authorized. The analysis of the bank's discriminatory lending found that a large number of those loans were to Black and Brown customers in Philadelphia. They were high cost and high risk compared with that of the loans made to white borrowers. The city filed a suit in 2017 against Wells Fargo for violating the Fair Housing Act by taking advantage of minority borrowers to maximize profits. And more recently, the city has been engaged in an antitrust lawsuit against 7 major banks, including Bank of America and Wells Fargo, for conspiring to inflate interest rates on variable rate debt, costing the cities billions of dollars in excess fees. This amount that's paid in fees, it takes away from citizens' ability to access public services, such as schools, transportation, and other public goods. Financial exclusion, exploitation, and racial injustice are deeply ingrained in the country's banking system and its institutions. Public banking can move us away from this and help finance affordable housing, cooperatives, small business, education initiatives, and financial services. The bank can prioritize investment in communities of color and institutions owned or controlled by members of the actual community. Because the responsibility is not to shareholders but to the public, the bank has the opportunity to make a profound impact on Philadelphians. A public bank doesn't return profits to individual stockholders or pay out-of-touch salaries to bank execs. The revenue can return to the city and fund much-needed community development and infrastructure projects, expanding the bank's reach. In Philadelphia, 10% of households are unbanked and 22% are underbanked. This is more than state and national averages. Being unbanked or underbanked is expensive because of harsh fees such as payday lending or even overdraft fees in traditional banks. Fees to payday lenders and check cashers cost households an astonishing $173 billion a year. But even traditional banks charge steep and onerous overdraft fees and excess activity fees, which are meant to actually deter small accounts. The Philadelphia region has had the highest average overdraft fee among the 25 largest metropolitan markets in the country. Small accounts are not profitable for banks, and so they avoid offering them, leaving many communities in what some analysts call banking deserts. A public bank can help address this by providing accessible, low-cost banking services and products directly or in partnership with community financial institutions. This bill is a really great step toward a chartered bank in the city. Public banks can hold public deposits and are chartered to serve the public good. They serve as a powerful tool for local governments to address local needs. Through public banking, the city can build on its existing relationships with CDFIs and other non-extractive financial institutions to expand fair banking access and deepen the investment in affordable housing, small and worker-owned businesses, green financing, and other needs. In the example of the Bank of North Dakota, the bank participates in partnership lending for economic development. The bank partners with community banks in making loans and extends credit into those communities. They offer smaller, community-oriented banks and credit unions that help diversify safe alternatives to traditional banks. Public banks can also allow cities and states to finance critical public projects at much lower interest rates than traditional banks on the bond market. It would also allow the city to be intentional with where they place their money. Once capitalized, the city could move their funds out of banks that engage in redlining and predatory financial practices, fossil fuel financing, real estate speculation, and other activities that harm communities, specifically low-income Black and Brown communities. The existence of a public bank is crucial for all Philadelphians. A public bank in the city would be historic, and it would give us an opportunity to depart from the traditional banking systems that have proven to be both racist and extractive. Thank you for your time, and I'm happy to answer any questions.
Thank you, Ms. Alston. Ms. Nevins, please proceed with your testimony.
Thank you, and good morning, Chairman Green and members of the Finance Committee. My name is Ann Bovaird Nevins, and I serve as president of PIDC. I'm here today to share the mission and vision of PIDC and also the Philadelphia Authority for Industrial Development, or PAID, as it relates to Bill number 210956. And first, I want to thank and recognize Council Members Jones and Johnson for their dedicated service on PIDC's Board of Directors. PIDC strongly supports the community investment goals of this bill, and we work to achieve those alongside many partners. I'm glad to be here today with Regina as the African American Chamber of Commerce president, being one of those key partners, and we are very proud to be supporting the Chamber's inaugural Coaching to Capital program, as Regina had referenced. I'm sure that many of you are familiar with the recent assessment of Philadelphia's entrepreneurial ecosystem, which underscored the major racial disparities for Black, Indigenous, and people of color-owned businesses that are a key driver of today's discussion, and which you have also just heard a lot of information on from Regina, from Leslie, and from Ms. Alton. That report outlined also that one of the primary challenges in addressing the disparities is a lack of sufficient resources, as well as a complex system with many different organizations that can be difficult for both the service providers or the support organizations, as well as, and most importantly, the business owners themselves to navigate. But that report also noted that we are starting to bring together existing groups in new ways with organizations like the Collective, the Pennsylvania CDFI Network, and the Greater Philadelphia Financial Services Leadership Coalition. PIDC is playing a role with each of these groups and more, and I hope that we can leverage and invest even more in the existing and emerging infrastructure that needs resources to achieve its potential, while also ensuring that anything new that might get created is complementary rather than duplicative. PIDC and its affiliates currently represent a best practice in community-based economic development by offering a broad array of financing and real estate solutions, together with supportive business services targeted to Philadelphia's minority, women, and low-income communities. To borrow a phrase from our PIDC board member, Councilman Jones, we are not the same PIDC, maybe of the 1980s and 1990s, that focused primarily around larger industrial and commercial projects at that time, but we really have broadened our services and outreach to focus and better meet the needs of small businesses, community-based nonprofit organizations, and neighborhood development projects. Few, if any, organizations in the nation combine the value of our sort of three-part structure that includes a private nonprofit-based CDFI, a CD, and a CDE, with the public-private partnership represented by PIDC and a governmental authority represented by PAID. PAID, as I just referenced, is the governmental authority that was created under the same act and with the same powers as that proposed under this bill for the Philadelphia Public Financial Authority. Like the proposed authority, PAID was authorized by action of City Council to serve Philadelphia's business community, and its board members are appointed by the mayor. So the accountability is back to local government. And that board is currently chaired by Evelyn Smalls, the CEO of United Bank, which is the only Black-owned bank in Philadelphia. I also mentioned PIDC Community Capital, our CDFI. That is the private 501c3 corporation, which is certified by the U.S. Treasury as both a CDFI and a CDE. Similar to some of the discussion today, PIDC pursued these certifications specifically to obtain additional private and public resources as a catalyst to investing in underserved communities. And that entity, PIDC Community Capital, is a proud member of the Pennsylvania CDFI network, which was formed last year and successfully facilitated the investment of more than $77 million into Philadelphia's small, minority, and women-owned businesses in response to the devastating impacts of the pandemic. When we talk about lending and talk about credit quality, I also want to know in terms of how we think about that at PIDC, sort of across all of our different entities. And we really focus on extending interest rates, terms, and credit that are below market and more flexible than other banks and even certain other CDFIs. This flexibility includes working with applicants that have had past bankruptcies, tax delinquencies, or business failures. It includes working with businesses that have had negative profits or are under collateralized within the last 3 years, which is very different than typical commercial bank lenders. It includes lower debt coverage ratios and lower credit ratings than would be otherwise acceptable. And this can work even for organizations like cooperatives, where PIDC has provided funding in the past to Weaver's Way, Mariposa, the South Philly Food Co-op, and the Kensington Food Co-op. Response to the devastating impacts of the pandemic and the closing of the economy, and in addition to the emergency relief grant programs that we managed and that we've testified with this council previously, PIDC also created the Restart Loan Program. This is targeted to historically disadvantaged communities with a specific focus on minority, women, and immigrant-owned businesses located in low-income communities. To date, we've deployed more than $4 million in 39 loans, and just a little sampling, Wardlaw Fence, which is a Black-owned residential general contracting company in the 8th District, VRPO Construction, an Asian-owned general construction services company in the 2nd District, Rolo Vinyl, Black-owned company located in the 5th District, specializing in custom printing, Wilco Electronic Systems, a Black-owned business in the technology space in the 8th District, La Fortaleza Physical Therapy Centers, located in the 7th District, and Magali Spa, a woman and immigrant-owned health and wellness center located in the 9th District. Another example of the ways in which we are looking beyond the impacts of the pandemic, but focusing on the wealth creation and addressing some of the historic gaps in particularly around racial disparities, is through our commercial mortgage loan. This was designed specifically to help small businesses purchase property and, again, build assets leading to equity and wealth creation. Here, we've provided, this is a new product, and we've made about $3 million in loans through this so far, including Little Pearls Academic Center, a daycare with 2 locations in the 4th District, Kingdom Cuts and Confections, a Black and woman-owned business located in the 9th District, and Franny Lou's Porch, a Black and woman-owned cafe located in the 7th Councilmanic District. And at the same time as we focused on access to capital for diverse businesses, we've also adopted new strategies to ensure that larger scale projects in Philadelphia are more impactful in creating opportunity for wealth building and jobs. An example of that in the 4th Council District is the development of a new office, cryopreservation facility, and safety stock warehouse in West Parkside for Supra Emsco, which is a Black-owned enterprise where PIDC was able to both sell the company the land for that development, as well as provide financing through New Markets tax credits and loans. And as Leslie Smallwood referenced, in selecting the development team of Ensemble Mosaic to become the new private development partner at the Navy Yard last year, that group's commitment to diversity, equity, and inclusion at all levels, including the development ownership, played a significant role in differentiating their proposal for PIDC. Since that time, Ensemble Mosaic has launched a bold commitment to DEI and has so far hired 20 local and national minority, women, veteran, and other disadvantaged-owned businesses for $7.5 million in contracts, totaling 50% of the spend for the design phase of the project. And at the same time as that has been happening at the Navy Yard, we've also launched a new pilot program in workforce development to connect and underemployed Philadelphia residents with quality job opportunities at the Navy Yard, including employers like Four Seasons Total Landscaping, Philly Shipyard, and Tasty Baking. Now, despite these efforts and those of our partner organizations, I fully recognize and wholeheartedly agree that major and unacceptable gaps and disparities still exist, particularly for BIPOC-owned businesses and development firms and for communities of color. We have to do more and we have to do better. And as we started the year of 2021, PIDC made a strategic commitment to deploying our resources across all that we do, from lending to real estate to our own purchasing power, in ways that address racial inequity and poverty in Philadelphia. This commitment has been fully embraced by our staff and board and will remain a critical element of our strategic priorities moving forward. PIDC is excited to continue its longstanding partnership with both City Council and the administration to continuously identifying the areas of highest need and innovate to create the tools that are needed for investment. We hope that our structure, coupled with new resources from the public and private sectors, will allow us to continue to execute on that mission and expand and increase investment in communities that have been historically denied fair and equal access to capital and services. Thank you all very much for the opportunity to testify today.
Thank you, Ms. Nevins, and I want to thank everyone from the panel. I know, Councilmember Dom, you have a question?
Yes, thank you, Mr. Chair. I have a question for Ann at PIDC. I was curious, Ann, how many loans has PIDC denied in the last 2 years, roughly? And also the other reason why those loans were denied.
Yep. So the report that I've got in terms of files at about 20 loans, and the reasons range from the length of time that the business has been open and operating. So that is something where PIDC typically looks to support businesses that have been in existence for at least 2 or 3 years. If we don't provide so we don't typically fund startup enterprises, and that is something where we partner currently with some of the other community development financial institutions that are in our marketplace to be able to serve those businesses. That, I think, is a big part of why it's important that the Pennsylvania CDFI network has come together to be able to make sure that there is a continuum of capital. Not any one organization will likely be able to serve the needs of all businesses, but if we've come together as a coalition, then there should always be sort of a right door and a right place to make sure that each business seeking capital has a good partner to work with. Another reason has been kind of insufficient ability, not having an ability to show that the business would be able to pay back the debt. And I would say, that's something that any lender is really going to have to look at. And, you're really going to want to make sure that you're putting somebody, you're putting the business owner, the entrepreneur that you're working with in a position to be successful. And sometimes, that could mean, not making a loan that there doesn't seem to be, based on a lot of assessment and a lot of handholding and a lot of working, kind of individually with the business, an opportunity for that person to viably pay the loan back. That's something that doesn't put them in a good position, and it also wouldn't put, whether it's PIDC or any, organization in a good position. But as I said, there's a lot of the things that we look at. We look past bankruptcies and tax delinquencies and past business failures. And, if the historic financials don't show that the debt service coverage can work, but the future projections do show that it can work, we have a tremendous amount, more flexibility than a regulated financial institution would in looking at that. And then I would say the other thing that we really do is, rather than turning people down, a lot of times what we will end up doing is just sticking with a business and working with them until they're ready. So we do a lot of programs in terms of we have, for example, in partnership with an organization called Clarify that works with individuals who are seeking to improve their personal credit. We actually launched with Clarify a credit boot camp for entrepreneurs. And so it's specifically focused on that nexus between how the personal credit of the business owner impacts their ability to successfully access financing for their business. And so we've been working with cohorts of maybe, 25 or 30 entrepreneurs at a time with Clarify to really support those entrepreneurs in helping to, pay off debt, helping to have strategies to sort of manage their finances in a way that are going to make them successful. And sometimes we've done that, maybe as a condition of our loan, like we're going to approve the loan, but we also want you to go ahead with this, this Clarify entrepreneurship or credit boot camp. And then in other cases, we might say, why don't you go through this first, and we're going to walk you through it and sort of stay by your side, through this time. And then when you're done with that program, let's reassess and let's see if at that point, we can be able to move forward with the loan.
I guess my question is I was on a board of a bank 25 years ago, but I remember being drilled into my head. It was the ability to pay and the willingness to pay were the key ingredients in making a lot of the loans. On the 20 loans that were denied, do you think that this entity that we're talking about could have been helpful to those 20 businesses that did not get loans?
Well, I think I guess it sort of depends. And I think that would be really where, again, it would almost be like a policy decision, right, of the city in terms of how, kind of how you wanted to deploy funds. So we could, and I would be happy, to sort of work through this, we could maybe take a sampling or sort of, of redacted, obviously, and sort of look at, the instances in which we weren't able to move forward. And sort of talk through, okay, well, what would we have needed, to move forward? In some cases, it might actually be a grant to the business. Sometimes the business, again, and this is, this is very much tied into everything that you just heard from the other three panelists around historic, systemic, multi-generational discrimination that has led to lower wealth and lower access to friends and family, type of capital, to pick up on, what Leslie was talking about, where a business owner might not have, the access to the early stage capital that they need and can create that cushion for the business in tough times. So, sometimes, if it's a grant fund might actually be what's most helpful. Sometimes it could be, as, Councilman Green has said, a guarantee of the loan so that, there could be additional, additional risk taken on the part of both the lender and the borrower. Because if the guarantee is structured in such a way that, that's the first thing, like it's the first loss money, and you're not, going to look to the borrower to repay. I think, that there might be, some challenges with with that, but if that was the premise, if that was sort of the policy decision, and this was looked at really as that first loss capital, that could certainly make a difference in terms of having a a pool of funds to be able to draw from, and go ahead and do additional additional lending. Again, if it's not going to be harmful to the borrower either, because we don't want to put somebody in a position where they're they're incurring a debt that they are not likely to be able to repay unless there's another source of funds that could be readily available to do that.
Can you clarify something for me, Anna? Did I hear you say that to get a loan from PIDC, you have to be in business at least 2 years?
Yep, that's about right. So we usually look for, for a business to be in operation for 2 years. And again, as I said, we work with a network of the CDFIs. There's actually 11 CDFIs, including PIDC Community Capital, that operate in the city of Philadelphia and support small business lending. They're all part of the broader Pennsylvania CDFI network. And within that network of 11 Philadelphia-based CDFIs that do small business lending, quite a number of them do startups. And that includes also some of the lenders that use the SBA guarantee programs. PIDC does not currently utilize any of we're always, evaluating whether that's something that we should, but those can support startup enterprises, and so that I would say is we're primarily working with startup businesses to get connected to some of our other CDFI partners.
I guess the challenge, I think, is a small business starting out. Let's just say they've been open 6 months or a year, and they show the ability to pay and the willingness to pay. I would want to see them get the opportunity to lock in financing at today's rates, rather than have to wait longer when the rates will probably move up. So I think that we should look at that, because to me, today is an opportune time. I've been around a long time. I remember when interest rates hit over 20%. Today, what are they at? 3%. So if we can get that locked in financing for some of those businesses in general now, even after a year or so, or 6 months, waiting 2 or 3 years, I think, is, who knows where rates will be. And I think that makes a difference with a business borrowing at 3%.
Absolutely. And Councilman, actually, I just should say I just got a message from a couple of my colleagues reminding me that we've actually made an exception to that with our Restart Philadelphia loan program, which is actually a 0% interest loan. We're able to do 0% interest loans with this because it is a grant funded program. So we were able to successfully secure grant resources for that. So we can both, because it's grant funded, we can take, sort of a different approach from a risk perspective, and we can also put the money out at 0%.
Okay, thank you. I have one other question I wanted to ask either Rob or the chairman. I'm listening to the services that PIDC would provide. Who would provide those in this new authority? How would that exactly work, or that has to be figured out?
Well, and thank you, Councilmember Dom and Ms. Nevins, for your testimony, your questions. As I was saying earlier, under this new entity, you have a corporate board that's appointed, and then that corporate board would appoint a policy board that has to meet certain characteristics and qualifications. That policy board, for all intents and purposes, would be like the lending committee that you see in traditional banks, and I experienced when I was a lender. In addition, an executive director would be hired for this entity as well. So between the executive director and the staff that she or he hires and the policy board, there would be entities that will be providing the decision-making as well as the day-to-day operations.
But it sounds almost like, could that be duplicative? Like, it sounds like we have that entity at PIDC. We're going to have it for this new authority. Is there any way to make it more efficient and utilize one overall board? I'm just throwing out the idea.
Well, I mean, they're two different entities. Also, PIDC has multiple entities as part of, and PIDC is a joint venture between the City of Philadelphia and the Greater Philadelphia Chamber of Commerce. And as I stated earlier, we're trying to help PIDC and other CDFIs actually do more lending by helping to mitigate their risk, so that way you don't have an entity doing both the guarantees and the actual lending. However, I've had numerous conversations with Ms. Nevins, as well as the chair of her board, Sal Patty, as well as Evelyn Smalls, who is the chair of the paid board, who I've known for a long time as the president and CEO of United Bank. And just like with the Accelerator Fund that was created by Greg Heller and others, on paper have a lot of similar dynamics as some of the work that some of our existing entities do, although the Accelerator Fund is focusing more on housing development. They are talking through a collaboration, and they're working through that, and I can envision the same perspective in reference to these entities and other entities, and how we can be partners with them and help them do even more work and free up their dollars to do more direct lending.
Okay, thank you. I have one last question for Ann. Do you think this could be supportive of your efforts at PIDC?
Well, I think, based on the conversations that the councilman and I have had, I think I really appreciate, his focus in terms of what can be most complementary. And, as he said, I think earlier, avoiding reinventing the wheel. So to the extent that there could be that type of capital, like the loan guarantees, or if there's other, ways to bring public sector resources into this space in a way that, they haven't traditionally been invested. I will say, one of the reasons that PIDC actually created the CDFI, which dates back to about 2013, was that at the federal level, the state level, and even at the local level, support financial support for economic development and small business growth had just gone down and down and down and down. So, over many years, there were lots of different, kind of programs and initiatives that brought that, level of support, way down. And so we said, wow, like there's huge amount of need in the community. We need to figure out new mechanisms and new ways to do more. So that was when we created the CDFI, which allowed us to go, and secure lending facilities from banks, secure philanthropic investment as a CDFI and a 501c3 nonprofit, pursue new markets tax credits and kind of a range of other things. So I think we've kind of already had to adapt in that way. And I guess I would just say, I would look forward to having opportunities to continue discussions about how we can, how we can collaborate and how we can bring more resources to address the gaps and the needs that I think we all agree are really important to tackle.
Okay, thank you. Thank you very much. Thank you, Mr. Chairman.
Thank you, Councilmember Dom. I've been going back and forth my phone because one of our colleagues who is voice challenged is not able to ask questions directly, so I'll make sure I'm going to read her questions for you. So this is from Councilmember Gim. This is for Ms. Nevins, if you're still with us. Okay, this is from Councilmember Gim. One of the things we know is that by nature, banking, lending, and other financial systems are geared against BIPOC and low-income individuals, especially in emerging fields. One of the reasons for this is because the deciding board reflects existing political and financial interests rather than a public interest that seeks to counter it. So she has a few questions. First question, how has PIDC changed the decision-making composition of its board or other entities to better reflect community-driven interests?
Sure. So in terms of our lending, PIDC has a loan committee that looks at, all of the work that, all of the loans that we bring for approval. So that loan committee, we have added and updated the composition of the membership over the last year. And one of the things that we're actually doing right now is updating our loan policy and our risk rating. So we're just about to go out with a process to have a third-party support on that. And one of the things that we've done, even before going out to solicit the services of finding a partner to work with us on the updates to the loan policy and risk rating, is to have the organization that we're working with, which is a firm, Madison Advisors, led by Christina Madison. It's an African-American woman-owned firm. They're working with us across multiple dimensions of our strategic planning right now, all of it with a lens specific to racial equity and diversity, equity, and inclusion. And they are working with us to review even like the scope of services before we put that out there. So that is something that we're actively in the process of doing right now. During the pandemic, we also added to our risk rating system an impact scoring that looks at the demographics of the borrowers, that looks at the location of the business in terms of whether it's located in our low income or high unemployment communities. It looks at whether the business is creating jobs for Philadelphians. So it kind of puts together that impact scoring so that we can look at that at the same time as we are looking at the at the risk, and even in instances where the risk rating might be lower, meaning that there's more risk to the particular loan, we can balance that out with looking also at the impact and making that decision to say, yes, this is something that we should move ahead. And with our restart loans specifically, we actually changed the approval structure so that those are approved just at the loan committee. They don't require any further approval at the board level. And we're able to, do that for a couple of reasons. One, it just helps, make things move faster, just one less step in the process at a time when we knew that people were, really going to need access to capital as quickly as we could provide it. And so those are some examples of some of the steps that we are taking, but it is absolutely, continues to be a work in progress.
Okay, so I'm going to ask a few other questions, Councilor McGinn. What other efforts is PIDC taking to ensure spending decisions are prioritizing community-driven projects, and how is PIDC measuring its lending community-driven businesses or projects?
Yep. So as I mentioned, the strategic planning process that we are going through with Madison Advisors, that is really a big component of what we are working on with them. So that engagement got underway in October of this year. And it really focuses around our existing strategic priorities. One of those is to demonstrate leadership and take a leadership role in an equitable economic recovery for Philadelphia. And the other is what I mentioned earlier in terms of deploying PIDC's resources in ways that address racial inequity and poverty in Philadelphia. At the moment, our working kind of theory of change, and this is really what we're working with Madison Advisors to further flesh out. We're going to have stakeholder engagement. We very much look forward to engaging with City Council for your perspectives on this. You'll be hearing from us and from the Madison Advisors team soon. But the working theory is that ways to do that are focused around two primary areas. One being to focus on investing in small businesses in ways that support their resilience and wealth creation. So the commercial mortgage lending program that I mentioned is part of that as a new product. And we actually saw a huge uptick in the beginning of 2021. There was really a lull during the pandemic in terms of interest in that commercial mortgage loan product. And I think we attributed that to everybody being focused on kind of survival, focusing also on accessing a lot of the relief grants and those types of programs. But we really saw huge interest come back to life in the first quarter of this year for the commercial mortgage program. That's something that we think has tremendous growth potential. And that's actually something where we really think that some probably small amount of grant dollars could make a really big difference. So if we had grant funding that we could help a business fill the equity capital that they would need. We're typically doing like 90% financing on these, again, much less conservative than, what a bank would be. But there's still some funding that we would expect the business owner to be coming up with. And I think that's, one of the things where we feel like we could do even more if there were some grant dollars that were available for that program. So that's something that I think, maybe we could work on jointly. But the commercial mortgage program is a big piece of that in terms of the wealth building. And I mentioned some of the loans earlier in terms of, different loans across the various council districts. And then, another piece is around the idea of quality jobs. So that's something that, we are really looking at. How do we be more intentional about connecting the job opportunities that are created through some of the investments that we're making, particularly in a place like the Navy Yard, where we have a special, role in that development. How are we really making sure that those job opportunities are accessible to and underemployed Philadelphians? And that's where we've launched a new partnership with the West Philadelphia Skills Initiative to do a whole workforce training and development initiative that we're investing in, that West Philadelphia Skills is investing in, and that we think can not only serve as a model that we will continue to expand at the Navy Yard, where we've seen primarily jobs in as I said, landscaping, the shipyard, and now most recently we've been recruiting a cohort to start at Tasty Baking. One of our other manufacturing employers is going to be launching a cohort next year. We're working on another one with Philly Shipyard, and we hope that this will also extend into some of the healthcare and life sciences employers at the Navy Yard. And again, only for Philadelphia residents. And so we're connecting people who are and underemployed directly to employment opportunities. And we've had, I think 93% placement rate was our most recent, placement rate in terms of getting people into actual jobs.
And then last question, are there opportunities for community members to review PIDC's spending decisions and provide feedback, and is there any type of public hearing process?
Well, there's not like a sort of public hearing process apart from obviously, coming and participating in, in these types of opportunities to engage, with you and other council members. But I would certainly be happy. I mean, this is something, again, we've got our strategic planning process that we are getting ready to initiate our stakeholder engagement, hearing from council and hearing, your perspectives about, how we do what we do and how we can do it better. That's going to be a really important component of that strategic planning process. So I'd be happy to talk about that further.
Okay. I don't see any other questions from members of council. Ms. Nevins, Ms. Alston, Ms. Hairston, and Ms. Smallwood Lewis, thank you for your testimony. Mr. Iannuzzi, if you could read the names of the next witnesses that are scheduled to testify.
Alan Brown, Chair of the Public Banking Institute, Walt McCree, President of the Public Banking Association, Public Banking Associates, and Scott Baker, Managing Editor and Economics Editor at Op-Ed News.
Okay. Ms. Brown, if you could proceed with your testimony. Okay, while we're waiting for...
Can you hear me?
Okay. We can hear you.
Okay, great.
For the record, and then proceed with your testimony.
Okay, my name is Ellen Brown. I'm chairman of the Public Banking Institute. Thank you so much for this webinar. It's been really educational to me. I mean, very informative, particularly all the issues you're facing, and I think you all are doing a great job. I'm very impressed. I'm not sure what I can add except as a sort of historical overview, maybe to inspire you why this work is very important. Philadelphia, as you probably know, it was the birthplace of public banking in the country. In the early 18th century, a land bank was formed. In 1693, the first colonial paper scrip was issued. So the colonies were issuing paper scrip supposedly as an advance against taxes, but it was a lot easier to issue the money than to pull it back in taxes. So the northern colonies were overissuing and hyperinflating their currencies. So Pennsylvania got the clever idea of forming a bank. So they would issue the money at 5% interest, which at that time was a very good interest rate, to the farmers who would then pay back the loans. So it was a sustainable system. Meanwhile, and this grew into what was called the American system, Alexander Hamilton's bank. It was Henry Clay that gave it the name the American system versus the British system. With the British system, the Bank of England was formed in 1694. It was a group of private investors who lent money to the king, and they actually issued banknotes. This was a year after the American colonists first issued their banknotes. So they issued money to the king, supposedly backed by gold, but because they had they knew that they could lend 10 times as many paper notes as they had gold. Basically 90% of it was counterfeit. So they were just issuing the paper currency. They issued the principal, but they didn't issue the interest. So over time, over the last 3 centuries, we're still operating basically on that system. And this is largely responsible for the wealth divide. I mean, you can imagine if a bank is issuing as much or taking back as much in principal as it issues in interest, as is typical, like for a housing loan, that money is being drained off, has been drained off for over 3 centuries into the financialized markets away from the real productive markets. So we need to get it back into the real productive market. $160 billion in interest is siphoned off annually by big banks and bondholders from state and local governments in the U.S. today. So that's a huge chunk of money that we could get back if we were borrowing from our own banks. And infrastructure is 50% interest, so that money could be saved if we were borrowing from our own banks. We only have one publicly owned bank. I'm sure you're a state-owned bank. That would be the Bank of North Dakota. But they have definitely proved the model. And then in Germany, we have the Sparkassen banks, which have also proved the model. In the Sparkassen banks are, along with the credit unions, are 90% of the local or the retail banking. That the 90% of the deposits go into those banks. They are only allowed to lend in their local communities, and because of this, they lend for productive purposes. They lend to their businesses, and for this reason, they are very productive. They have nearly as large of an export business as China, and they only have 6% of the Chinese population. So, and they attribute this to their banking system. They're local banks that know their local businesses, and therefore they know where they don't take risks. They don't actually lose money. I mean, they invest in good businesses, and it's worked out very well for them. The Bank of North Dakota in 2019 just finished 16 years of record-breaking profits, averaging 20% return on investment, which according to the Wall Street Journal in 2014, they were actually more profitable than Goldman Sachs and JP Morgan Chase. Now, how did they do it? That article said it was due to oil, but the oil market crashed that very year, and it never really came back. So their real secret of success is their banking model. They've cut out the middlemen. They don't have they don't have private shareholders who are demanding short-term profits. They don't have high-paid CEOs. You probably know all this. But anyway, they by law, all of the state's revenues are deposited in the banks. So they have a massive deposit banks. They don't have to advertise for depositors, and they don't advertise for borrowers. They partner with the local banks, which actually engage with the clients. And so the Bank of North Dakota just helps with liquidity, helps with capitalization, and in today's environment, they help with regulatory requirements, which are killing the local banks. So they actually have 6 times as many local banks per capita as any other state, largely because the Bank of North Dakota helps, partners with them, helps them out with all those requirements. They made more PP loan, payroll protection plan loans during 2020 than any other state per capita. They've always been good in crises. They step right up and fund where during that they had some floods where they would do mortgage, or I think in the 1930s, they actually did mortgage, whatever you call it, where they didn't collect on the mortgages, in other words. So they help out their people in a crisis. So it's been a very useful tool for North Dakota. So according to the Bank of England in their 2014 quarterly report, banks actually create our money supply. They've been creating our money for the last 300 plus years. The Bank of England said they actually create 97% of the money supply. They said, contrary to popular belief, banks are not intermediaries that just take in deposits and lend them out again. They actually create deposits when they make loans. So this is a power that we, the people, need to get back. We should be creating our own credit. That was called the American system by Henry Clay versus the British system. So that was what Abraham Lincoln did, what Roosevelt did to get us out of the Depression, what John F. Kennedy was proposing to do, but didn't manage to do it. So this is our American system that we need to get back to. We, the people, should be in charge of creating our own money, and that money, the credit should be directed into our own local communities. And it's very exciting to us to see Philadelphia doing such a great job on this venture, because Philadelphia was the birthplace of the whole model that we're talking about. So thank you very much. I doubt you have any questions for me, but I'm willing to answer questions.
Okay, thank you, Ms. Brown, for your testimony. I think Mr. Baker and then Mr. McCree, in that order.
Okay, thank you for having me on today. I hope you can see my screen. If I can't see the screen. Let me just open this. Okay. All right, so basically, I'm going to talk about the what's actually in your accounts right now. So I wanted to correct one statement that was made earlier, that basically that there's no that there might be a competing interest in the money that's already in deposit. Actually, that doesn't really have to happen, because what you have is you have about 6.6 billion in liquid assets right now, and so you don't really lend that out. As Ellen said, money is created when it's made into a loan, so that money is not really lent out, and so actually it stays in your account even if even if the bank would make a loan on it. So let me just go back one level here. So basically, I went through the comprehensive annual financial reports of your city, and I found out where the money was, and basically figured out what was liquid and not fixed capital, which we can't use obviously for a bank. And so what I wanted to talk about today was just what the deposits were versus the capital. And so you have two kinds of investments into a bank. You have the deposits, and your deposit base could be used as the Bank of North Dakota does from your tax revenues. And so that's a very reliable source of money. And so basically you don't have to you don't have to have this guarantee, this collateral, because you already have the money and you know it's going to come in on a consistent basis and not, let's say, just on April 15th. So it's coming in all year, it's going out all year, but basically it's fairly predictable. And so when you make a loan, what the Bank of North Dakota does, even though it only has 3.9 billion in loans, it has an additional 2 billion or so to make, or actually 3 billion to make a $7 billion bank. So the additional assets are in short-term securities like treasuries and that sort of thing. So if they need to, they can sell off some of the treasuries and they can balance out to make their compliance ratios into the bank. So what you really have to do is take a look at what you're investing in right now. And when you look at the Comprehensive Annual Financial Report, the CAFR, you see some of the things they're investing in are actually much more risky than the well-managed public bank ought to be. So this is an example right here. And now I understand that they're trying to get 7.5% return on investment, but they're not really getting that. So they're really getting, according to the home report on page 109 to 110, they're getting 1.89% return on investment, and that's even with taking very high risk investments such as you see listed here in these asset classes. So this is directly from the report. This is not from me. This is right there in the actual CAFR from last year. So I think that any objective analysis would show that this is actually a more risky portfolio than investing part of that money, let's in this case from the pension fund, directly into a public bank. So in addition to that, we've got foreign currencies, which can have all kinds of political repercussions as well as financial risk. So these are the foreign currencies that are held by the pension fund as well. There's derivatives. Yes, the Bank of North Dakota does have a few derivatives, but not nearly as much as the pension fund. So we propose that instead of, or in place of some of these investments, you would use the pension fund as a way of capitalizing the bank, to provide that 1/9 of the portfolio that can't go in and out of the bank, that has to be placed as reserve. And instead, you would use the city's money as deposits. And this way, the city does not actually have to give up any money because it can be used as needs require. But in the meantime, it serves as a base from which to make deposits, because as Ellen said, when a bank makes a loan, it actually creates money. So this is what the difference is between a bank and just say a revolving fund. Revolving fund can't make any loans until the money comes back again, whereas a city can, because it has a base in which if it had a bank, it could make a loan, and that loan would actually be an asset to the bank and not just a decrease in the deposit base. So we suggest that the risk that's already been taken by Philadelphia, including hedge funds and other things, is actually greater than the risk from a public bank, and so objectively we should be doing that. So Scott Stringer, who's our comptroller in New York City, actually did a report, and he said that over a 10-year period that basically the fees ate up all the returns on investment, and so there really wasn't any investment. It wiped out $2.5 billion in returns just because of the fees. And as you saw in your own report, that's pretty close to what happens in Philadelphia as well. So can you create a bank? According to your pension board, the fund may from time to time make investments in products and programs other than traditional stocks, bonds, and cash equivalents. So basically, to me, this asks the question, does a public bank fit into this criteria? So if you could create a public bank, could the pension fund invest in it? And I think the answer is yes, but of course you have to run it through your own pension board to see. Now, keep in mind that 95% of the pension fund is rolled over. It's never paid to pensioners to begin with. So you don't, and if it was, you'd quickly run out of pension money. So that kind of proves the point. So basically you can have that money roll over, and it's prudent and safe and counter-cyclical, to market downturns, able to provide consistent returns, and it's supportive of local community and job creation. And everybody has already agreed that there's not enough money to support the black and brown businesses that are strapped for cash right now and can't get any credit. So this is a way of doing that. It's fiduciarily responsible if it's set up properly to be so. So again, the usage of the tax revenues is predictable throughout the year, and these can form the deposit base for making loans. So basically you need to determine how much money you have and whether you can use those resources for investing in a bank. And well, I'll take questions now. That's my testimony for today.
Thank you. Walt McCree.
Okay, well, hello, everyone, and thank you very much for the opportunity to...
Walt, I apologize. And Scott Baker, I know you had testified earlier. Walt, if you can please give your name and title for our stenographer.
Sure, yes. My name is Walt McCree. I'm Chair Emeritus and Senior Advisor to the Public Banking Institute and President of Public Banking Associates, which is a national consultancy of banking and economic experts that are working with city and state governments to get their own public banks started. I'm very pleased to have this opportunity. I had the privilege of being able to help start the Public Bank Initiative concept for Philadelphia 10 years ago. And since then have spent that time learning and working with cities and states around the country who are in the same process. And so Ellen and Scott and I do a bit of a dog and pony show every now and then in various markets to address the opportunities that public banking presents. As you know, it's a relatively new thing in America, but there are 900 public banks around the world managing about $50 trillion. So while America is just kind of getting with it, with the exception of Philadelphia's early 18th century experience, we're really just kind of getting with the program. And it's very exciting. I must say, really gratified to see how dedicated and informed you all are about the commitments that you want to make with your money and how and where it's falling short and how the systems need to be improved. I think many times we'll hear people say, well, what problem are you trying to solve, with these public banks? And I think basically that comes down to a simple question, a strategic planning question, and that is, does the city or the state want to be forever borrowing its money for investment from the private capital markets on Wall Street? Or do you want to take the opportunities in front of you to create your own lending mechanism, which of course is what this municipal financial authority is about? And by the way, in San Francisco, Los Angeles, even in New Jersey, the idea of having an interim financing vehicle to lead toward creating a full bank is well considered and well on its way in being adopted. San Francisco looking at creating a municipal financial authority and process as well. Scott just mentioned, actually Ellen mentioned, that the problem we're trying to solve is an obvious systemic disadvantage that cities and states have. Last year, Wall Street received $160 billion from cities and states around the U.S. Philadelphia contributed about $250 million of that last year. And of course, we don't want to forget a few years ago that we spent almost $500 million to Wall Street that came out of our taxpayers' wallets and our city schools for those interest rate swaps. When that money goes to Wall Street, it leaves town for good. It doesn't stop off to help with affordable housing, or it doesn't repair any deteriorating infrastructure. It doesn't help local entrepreneurs of color, minorities, women, and so forth who need to get into the game. Credit is the lifeblood of any economy, which, by the way, is one of the reasons that public banks around the world have demonstrated themselves to be one of the greatest economic stabilizers around. Public banks lend into the local economy, and that is really the lifeblood of how the mechanics work. So, but I think we want to remember that these interim facilities, like this financial authority you're talking about, needs to be shaped around the understanding that you are ultimately going to move toward having a chartered bank. The need for that is, or the opportunity of that is dramatic, and I think Scott just mentioned it. We have wonderful agencies. I was so impressed with Ms. Niven's description of PIDC's involvement with local lending, how CDFIs take a front row seat. I mean, this is really terrific. But what we need is ultimately, is the ability to create new money, as Ellen was saying, create new money with the loans by leveraging our capital tenfold. Now, you just can't have that with a revolving fund or even a development group unless you have that special privilege of being a bank. So that's what we want to continue to focus on as you go through the mechanisms of devising a Philadelphia financial authority. It really is a unique opportunity to provide investment capital and to direct it at the people's will and with transparency and accountability. So it's kind of just the way it was here in town a couple hundred years ago, where we're giving people the money they need for their lives and for their businesses. Of course, Bank of North Dakota shows that very well. And as I mentioned, it's all over the world. Public banks really taking the leadership in investing in green technology. They really, even though they're smaller than the private banks in terms of assets, they've contributed well over 50% of the money to create renewable energy sources and so forth. Now, I want to keep in mind also that in moving toward a bank, that there are dynamic changes underway in banking around the world. If the city would have a bank to deal with, a mechanism, it would be able to participate in leveraging or creating digital platforms that would allow facilitating getting credit into the community sectors that would otherwise not have been available. New methodologies are emerging. Having a bank will allow you to take advantage of that or enabling it. So before they make any more noise next door here, I just want to thank you for this opportunity and congratulate you and Chairman Green on his really informed, careful, well thought out, robust handling of a very exciting prospect for the city of Philadelphia. Godspeed to you.
Thank you, Ms. Brown, Mr. Baker, Mr. McCree. I don't see any questions from members of the council. Seeing and hearing none, thank you all for your testimony, providing some perspective. You know, we spent a lot of time talking about the public bank and how it would work here in the city of Philadelphia, but your testimony really provided some background, background and perspective on the context of what's happening around the country in reference to public banking.
Chairman Green, can I add one thing? I realized I left out. Uh, even though banks create money as loans, the problem, of course, is covering the withdrawals when the depositors or the borrowers take the money out. So banks are really borrowers. That's what they do. They borrow your deposits and they become the owner of the money and you become a creditor of the bank. So if they ran out of deposits before 2008, they would borrow in the Fed funds market from each other. So they borrowed deposits from each other, but that market collapsed because they no longer trusted each other after 2008. So they resorted to the repo market. That market collapsed in September of 2019 when interest rates in the repo market went to 10%. So then in the spring of 2020, the Federal Reserve set up new safeguards for their banks. So if you are a bank, they set up actually it was the summer of this year, they set up a standing repo facility so that any qualifying bank can borrow from their repo facility. And in the spring of 2020, they said that any qualifying bank or any bank in good standing, in other words, could borrow from their discount window at 0.25%, only for 3 months. But it also says that these loans are renewable. It says renewable daily. So it looks to me like you could roll over the loans. So it seems to me that if you are a bank, you have access to very cheap credit. At the moment, I know there's the threat that they'll raise the interest rate, but even if they raised it to 0.5%, that's still incredibly cheap, cheaper than you could get credit anywhere else. And then you can lend it on to your customers since you have fewer costs than other banks, lend it on to your customers very cheaply. And it seems to me that they're kind of asking for trouble if they do raise interest rates, because there's something like a $50 trillion debt bomb riding on the, the economy will collapse if they do raise rates. So it looks to me like these rates are going to be low for a long time.
Thank you. Thank you for that additional context and perspective in reference to the complexities and dynamics of our banking system from both the private as well as the Federal Reserve and other entities that enable us to maintain our economy, but at the same time can be very challenging in that regard. At this point, we'll have Mr. Iannuzzi prepare to read the witnesses for the next panel. Thank you all for your testimony. Also, as Mr. Iannuzzi is preparing, just want to let members of the committee know that we also received written testimony supporting this initiative from Annie Choi, Policy Director from the Philadelphia Association of CDCs, Dan Hoffman is a resident, and also we received testimony from the President CEO of the Cross-State Credit Union regarding some concerns they have with this legislation, and we are engaging in conversation with them as well.
Susan Windle, facilitator for the Philadelphia Public Bank Coalition. Peter Winslow, who's a member of the Philadelphia Public Banking Coalition. Vanessa Lowe, co-chair of the Economic Dignity Team of Power. Pamela Haynes, member of the Philadelphia Public Banking Coalition. Greg Windle is representative of Philadelphia DSA. And Deb Feigart is Professor Emeritus of Economics at Stockton University.
All right. Thank you, Mr. Iannuzzi. Ms. Windle, if you can state your name for the record, then proceed with your testimony.
Well, good afternoon, council members, and good afternoon to the many members of the public who are tuning into this hearing today. I am Susan Windle, and I'm the convener of the Philadelphia Public Banking Coalition. In this coalition, I represent the Economic Dignity Team of Power Interfaith, as well as the Steering Committee of Philadelphia Neighborhood Networks. Our coalition is a group of Philadelphia residents representing various organizations and networks concerned with economic, racial, and environmental justice in this city. Some of us have been working together on this campaign since the first National Conference on Public Banking here in Philadelphia in 2012. Since then, we've grown in number and strength, and you'll meet a few of us very shortly. But before you do, I want to take this time to publicly acknowledge and thank our council champion, Derek Green, on behalf of all of us, for the persistently collaborative spirit with which you have approached the creation of this landmark legislation. I want the public and the other council members here to know that Councilmember Green has been in dialogue with members of our group since the first Finance Committee hearing on public banking in 2016. And when in 2019, the council member decided the timing was right to move forward vigorously with public banking legislation, he brought the coalition along with him to fashion the bill and to build public awareness about this concept of public banking and what such a bank could do for our city. He came to our evening meetings whenever needed and has met regularly with three of us. My calendar says at least twice monthly since maybe this time last year, maybe earlier, on Monday afternoons to make sure that the ordinance this council votes into law this winter will lay a proper foundation for the kind of banking, the kind of fair, just, and equitable lending practices that the people in the precious neighborhoods of our city so desperately need. And I don't have to tell the members of this council how desperate that need is. Through all the meetings and the email exchanges, Councilmember Green has listened deeply to our concerns, shared his own, discussed, sometimes argued, and finally integrated the best of our conversations into the substance of the bill that is before this committee today. Councilmember Green, we thank you. In the very act of collaborating closely and continually with us, you have demonstrated what a truly healthy relationship and productive relationship between legislators and advocates can look like. We look forward to more probing and fruitful conversations as together we bring a new way of banking into being in the service of this city that we all love. So thank you, council members, for the opportunity to speak here before you today. And I'm going to turn over the microphone to other illustrious members of our coalition.
Thank you, Susan. Chairman Green and members of the Finance Committee, thank you for this opportunity to speak with you today on behalf of the Philadelphia Public Banking Coalition. My name is Peter Winslow. I'm a Philadelphia resident. I received a BA in economics and an MBA in finance from the University of Pennsylvania. I'm a Deloitte alumnus and I conducted my own CPA practice in New York. I've taught accounting, finance, and business subjects at Cornell University, Hunter College of the City College in New York, Rutgers University, and Temple University. My business experience includes startups, ramp-ups, turnarounds, mergers and acquisitions, and other activities, including provision of financial services. 1/4 of banking in the world is conducted by public banks. Almost all banking in the United States, however, is the province of for-profit private banks. Currently, our country has only 2 public banks, the Bank of North Dakota, founded in 1919, and the Territorial Bank of American Samoa, founded in 2016. As you've heard from leaders of the Public Banking Institute, Philadelphia is part of a movement to establish public banking in the United States. Banking here should not remain an exclusive club for private benefit. Passage of Bill 210956 will not create a Philadelphia public bank, as Councilmember Dom has noted. The Philadelphia Public Financial Authority it creates will instead have the potential to become a public bank. The authority will need to establish itself and prove itself through successful operations on its way to becoming a public bank. City Treasurer Dunn will not deposit city funds into the PPFA until the authority becomes legally eligible to hold such deposits, and she determines that doing so is prudent. Similarly, the School District of Philadelphia, the city pension funds, and other entities will not invest in the authority until those responsible for their management determine doing so is appropriate. Associates have asked me the questions raised by Finance Director Dubow today. Won't the Philadelphia Public Finance Authority duplicate what PIDC and PAID currently do? Won't the PPFA compete with established banks and credit unions? My answer is no and no. You're establishing this new authority to help level the playing field for Philadelphians seeking credit for their businesses and their communities, to help correct the past and current injustices that have resulted in persistent intergenerational poverty, to unleash latent entrepreneurial energy that will improve the quality of life and expand the tax base of our city. Those are the ends we all seek. The means you choose to achieve those ends are provided by Act 102, the Economic Development Finance Law. The EDFL was enacted in 1967. The intention of this law is to generate multiple state and local authorities to address identified and emergent financing needs for the promotion of economic welfare. The EDFL was not one and done legislation. The EDFL has been a vehicle for policy innovation for over half a century. Of course, the new authority will exercise the same powers as other EDFL authorities. In that sense, every authority created pursuant to the EDFL duplicates each of the others. The way each authority uses its powers is what differentiates one from another. PIDC has achieved admirable industrial development since it began operations in 1958. But in all that time, PIDC and PAID have not succeeded in addressing adequately the priorities set for the PPFA, identifying and then filling gaps in credit availability for underserved communities. This authority seeks to supplement, not duplicate, what PIDC does. In a similar fashion, the PPFA will coordinate with two other organizations that are now getting started, the Philadelphia Green Capital Corporation, an offshoot of the Philadelphia Energy Authority, and the Accelerator Fund, an offshoot of the Philadelphia Housing Development Corporation. PIDC owns and develops real estate, such as the Navy Yard. PPFA will hold a loan portfolio rather than a real estate portfolio. PIDC is a partnership between the city and the Philadelphia Chamber of Commerce. PPFA will be a partnership between the city and the community stakeholder groups it serves, cooperative businesses, Black and Latinx-owned small businesses, advocates for environmental justice, affordable housing, education equity, and neighborhood empowerment. The PPFA business model is based on partnership rather than competition with other financial institutions. PPFA will be a banker's bank that nourishes the local financial ecosystem of CDFIs, CDCs, credit unions, community banks, and other lenders. Through targeted programs that provide credit enhancements such as loan guarantees, the PPFA will encourage existing lenders to serve new markets that they currently find unattractive. Together, for example, we can help close the $840 million lending gap for small businesses in Philadelphia that was identified in the feasibility study conducted by HR&A advisors for the city last year. The PPFA will seek to retain some portion of the city's funds for investment in Philadelphia, instead of giving our money to big banks for them to chase after profits elsewhere around the world. Even if the PPFA controlled all the city's funds, around $255 million, that amount would represent less than 5/10,000th of the $572 billion Philadelphians have on deposit in private banks. While the PPFA will not be a competitive threat to the big banks, it will be a major resource for the small local banks and credit providers. PPFA intends to become a CDFI that supports other CDFIs, to become a city depository institution, to obtain a PA bank charter and become a member of the Federal Reserve System, to lead the national public banking movement by becoming a municipal public bank. These aspirations are groundbreaking. They do not duplicate the activities of PIDC, PAID, or any other existing financial institution in Philadelphia. For these reasons and those presented by my colleagues, I urge you to vote for Bill 210956 as amended. Thank you.
Mr. Chairman?
We can't hear you.
Mr. Chairman, are you there?
Yes, sorry. I apologize. It was my office phone was ringing. I want to say thank you, Ms. Wendell and Mr. Winslow, for your testimony. The next witnesses to testify are Vanessa Lowe, Pamela Haynes, and then Professor Feigart.
Thank you. Good afternoon, council members and public, members of the public listening to this. This has been a fantastic day, just really great information. I feel like I've learned a lot, and I've been involved for a while. I'm Vanessa Lowe, and I'm speaking in support of this legislation today as co-chair of the Economic Dignity Strategy Team for Power, Philadelphians organized to witness, empower, and rebuild. Power is a coalition of over 50 faith-based institutions in Philly and nearly 100 statewide. We educate and mobilize our congregants to fight for economic justice. I've also spent more than 21 years in federal service working on access to capital for underserved communities. I've worked with the U.S. Treasury Department's Community Development Financial Institutions Fund, which you've heard a lot about CDFIs today. I've worked with the National Credit Union Administration, supporting a series of small credit unions and helping them survive and thrive. And most recently, I spent 2 years at the U.S. Economic Development Administration. I want to speak briefly on two issues that fuel my passion for this local financial authority. First, this is the chance to take our money back from Wall Street and have it support our city and its residents. The national cry for public banks is part of a growing movement that's been around for a while, but it's called socially responsible investing, impact investing. It has many names. But the idea is that our values and our ideas about improving our world should align with what we do with our money and to whom we entrust it with. Major cities like ours have depended on an outdated system of giving our billions of dollars of tax income and fee revenue to large banks for investing and sourcing bond funds. Those large banks invest those funds in ways that are often contrary to our city goals, to our residents' goals. This legislation allows us to keep our tax dollars here, save millions of dollars in bond fees, and most importantly, it lets local leaders have a voice in how those funds are invested to support our citizens and our city's long-term improvements. Second, and related actually, is the authority's capacity to support lending by partnering with, but not replacing at all, the city's network of community development financial institutions. This includes many credit unions. These CDFIs have been in the national news lately because they were the ones getting those PPP loans out to the small entrepreneurs. We read about and were disgusted by the loans being made to these public companies, those big restaurants. Some of them were even saying, I'm going to send this back because this isn't right. Anyway, so while Citibank and other large banks were processing those loans for those public companies, the CDFIs were at work getting those loans out. And this was throughout the country, but also here in Philadelphia. They were recognized with the federal, when the federal agency that funds them, the CDFIs, was awarded $1.25 billion in June 21. 19 million of that was granted to a list of 14 different CDFIs. And I'm just going to name a couple because some of them have been mentioned here. And I particularly want to point out some of them, the ones that are led by African Americans. The CDFI industry is wonderful, but in its way, it also has sort of a legacy of sort of the plantation mentality, as we sometimes call it, where it's been white leaders with other folks and people of color, while being sort of the recipients at times, also being lower in the totem pole of leadership. But Vested In, who is one of our guests on the monthly conversations that we've had with Council Member Green, the Enterprise Center in West Philadelphia that has been around now for almost 30 years and is actually thinking about and talking about an equity fund, somewhat of a new concept that would be absolutely wonderful and is so much needed. As we've talked about, it's not just access to capital, but it's how we're getting the capital. It's not just loans that are needed. Sometimes it's grants, sometimes it's equity. So anyway, the Philadelphia Public Financial Authority can serve as a partner to these institutions, not by competing, but by collaborating to identify the gaps in service and helping them to fill those gaps. Credit enhancements and guarantees from the new authority could be offered to those CDFIs most effective at reaching key populations. The consolidation of the banking industry as a result of regulation and credit scoring has resulted in a few large banks who are not interested in local depositors or businesses. They're not interested in small dollars. The local credit unions and other CDFIs are our remaining relationship lenders. They know and want to help their local members and customers. These are our city's financial partners, not Wells Fargo and not Citibank. Let's pass this important legislation and pave the way for other big cities to align their goals with responsible financial partners. Thank you.
Thank you, Ms. Lowe. I believe Ms. Haynes, and then we'll be followed by Ms. Feigart, which will close this panel.
Thank you. Thank you for the opportunity to give a testimony in support of this legislation. My name is Pamela Haynes. I'm bringing to this testimony my faith values from the Quaker community in which I'm embedded and a long experience of applying those values to the economic issues we face. So I want to talk about debt. And we've had a messy relationship with debt throughout civilization, but I think we all have some intuitive understanding of the difference between healthy debt and unhealthy debt. With healthy debt, everyone wins. Someone in the community with extra cash makes it available to someone else who could use a little capital to increase their well-being or productivity. Those increased benefits decisively outweigh the costs of the loan. Wealth has circulated in the community, more wealth is created, and everyone comes out ahead. Similarly, we can recognize debt that's unhealthy. Someone is in a desperate situation and needs to borrow just to survive. The only option is a high-cost loan from an outside entity whose only reason for existence is maximization of profit. Not only does the interest leave the community, but the person is left in even more debt with no greater capacity to pay it back. They've entered into a cycle of debt servitude. The only winner in this situation is the profit-maximizing entity, which is wholly without concern for the well-being of the individual or the community. That well-being is simply not on their books. I would suggest that the situation we find ourselves in as a city in the present is far closer to the latter than the former. We have a high debt burden to outside financial interests, a burden that is increasingly limiting our capacity to engage in the investment that would benefit us all. This is not the result of bad management, though there's always the possibility of some of that in the mix. It's the result of the growing centrality of the financial sector in our economic life and the increasing dominance of those who have capital over those who don't. In ancient Sumeria, they solved this cyclical debt accumulation problem, a problem which left those who were actually producing value without the means to continue, by regular declarations of debt jubilee. I see significant merit in that approach, but as the debtor, our city cannot easily declare a debt jubilee. We can, however, take steps to minimize unhealthy debt and keep our wealth in our community through the establishment of a Philadelphia Public Bank. We would save hundreds of millions of dollars in interest that currently drains out of the city every year to big banks and bondholders, and that interest would come back to our own public bank to be invested again and again. It's hard to imagine that something so sensible and healthy could actually be possible, but we have that opportunity before us. Please support this legislation and put the city on the path to establish a Philadelphia Public Bank.
Professor Feigart?
Thank you, Chairman Green, for allowing me to testify on Bill 210956. My name is Dr. Deborah M. Feigart. I reside in the Logan Square or Franklin Town or Spring Garden neighborhood in Philadelphia, depending upon which neighborhood map one uses. I am a distinguished professor of economics emerita at Stockton University. I am also a member of the Philadelphia Public Banking Coalition. As an economist, I'm very concerned about the impact of COVID and longer-term inequality on our economic development, our residents, and our city's fiscal health. We have severe needs, from investments in physical infrastructure to investments in people, all while carrying a public debt load at higher than necessary interest rates. A new financing authority could really benefit the city as we recover from the worst economic crisis since the Great Depression. I have published an economic impact study of a proposed public bank in the city of Philadelphia. The study uses regional economic modeling, specifically input-output analysis, a tool commonly selected by economists, urban planners, and consultants to empirically estimate the impact of a new product or service. The public bank would have a multiplied effect on economic activity in the city. The study is available to you as an attachment to my testimony. The chairman has it. My study is about a bank that lends credit. I understand that the proposed authority is only the first step toward creating a bank, but many benefits would be secured nevertheless right away, and even more benefits down the road. I calculated the economic impact on earnings, on jobs, and on value added, which is like gross city product. The overall takeaway is this. Every $1 billion in new lending by the authority would yield approximately $142 million of increased earnings in Philadelphia, 3,200 new jobs created in Philadelphia, and $1.5 billion in new metro area gross product in the metropolitan region we call Philadelphia, Camden, Wilmington. This new authority would complement our existing financial institutions and economic development authorities to further invest in underserved communities, small businesses, and housing. This would both broaden and deepen the credit available in the financial system. I urge you to support the bill. Thank you very much.
Thank you all for your testimony this afternoon. Are there any questions from members of council? Seeing none, thank you for providing some additional perspective and context from a host of areas. All of you have a range of backgrounds and experiences that definitely have added some additional commentary and perspective on this legislation and this initiative here in the city of Philadelphia. And I appreciate your participation and your ability to be here to testify. With that, Mr. Iannuzzi, if you could read the names of our final panel.
Thomas Earl, CEO of Liberty Resources Incorporated. Maurice Sampson, Eastern Pennsylvania Director of Clean Water Action. Margaret Lindsay, Public Policy Committee of the Philadelphia Area Cooperative Alliance. And Kay Lasker.
Thank you, Mr. Iannuzzi. Mr. Earl, if you can state your name for the record and then proceed with your testimony.
Yes, good afternoon. My name's Thomas Earl. I'm the CEO of Liberty Resources, the Center for Independent Living in Philadelphia. It's an honor to speak today in support of the Philadelphia Public Financial Authority and advancing this much needed initiative in our great city of Philadelphia. I want to thank the chair of this committee and a great council person, Derek Green, who's a champion for the disability community. As you might know from the name of my organization, we are very involved and interested in the advancement of independent living and inclusion of people with disabilities in all aspects of civic affairs in the city of Philadelphia, including housing, business opportunities, employment opportunities, accessible transportation, accessible affordable housing. It is our strong view that the need for competition among banks and banking institutions, whether public or private, is healthy competition. And competition that could be delineated by the commitment of financial institutions to the communities that they're supposed to serve. Liberty Resources, under federal mandate, is required to employ at least 51% people with disabilities, and our board of directors, our governance, is required to be at least 51% people with disabilities. Our mantra in the independent living movement is nothing about us without us. And the involvement of people with disabilities in financial affairs, lending opportunities, commercial residential loans, housing development are very important matters of civic engagement. Philadelphia has one of the highest populations of any major city of people with disabilities, including many disabled veterans. We fully support the advancement of the Philadelphia Public Financial Authority. As some of you know, in City Council, Liberty Resources has a housing development division, Liberty Housing Development Corporation. We have over 60 units of housing that we use for people with disabilities that we move out of dangerous nursing homes where COVID infections are running very high still, and use the housing units to transition people out of those facilities. The need for gap funding that we sometimes need for large projects that we've worked with Councilman Jones, with Councilwoman Jamie Blackwell, with new Councilwoman Jamie Gautier. What we call gap funding often comes from innovative opportunities like the Housing Trust Fund, vacant lands received from the city's land bank. All of these present a need for funding and creative financing that may not often be available through your typical local bank, such as PNC or Citizens Bank, etc. We know that private for-profit banks have often neglected the needs of people of color and communities of color, and the nonprofits that serve those vulnerable communities. It is our opinion that a public financial authority in Philadelphia would help close this gap. We are very supportive of the policy advisory council that would be part of the bank because it would require the inclusion of community stakeholders, and who better to decide what the local financial needs of a community are than the people who live in these communities and have a self-interest or stakeholder interest in the positive outcomes that can come with financing, lending opportunities, investment opportunities, reinvestment opportunities that a public financial authority could have. This initiative also dovetails with many of the other innovative efforts that the city has engaged in with the Housing Trust Fund, inclusionary zoning practices, the land bank, and hopefully not too far down the road, the increased use of community land trusts that will provide green space, urban agriculture, and increased opportunities for accessible and affordable housing for seniors and people with disabilities. Community land trusts are a very efficient and effective way to use vacant, blighted city properties throughout every community in the city and put them to productive use that will generate additional revenue for the city. And the Philadelphia Public Financial Authority could help advance the establishment of community land trusts and other innovative initiatives that will help all Philadelphians. So with that in mind, Liberty Resources and the many thousands of people that we serve throughout the city of Philadelphia fully support the advancement of this initiative. We are proud members of the Affordable Housing Coalition, which has evolved to be the Philadelphia Coalition for Affordable Communities, and support issues and initiatives that really advance the housing needs of our most vulnerable citizens in the city. Thank you very much for this opportunity, and happy to answer any questions. Thank you.
Thank you, Mr. Earl. Next, we have Maurice Sampson from Clean Water Action, Margaret Lindsay, Kay Lasker, and we also have Greg Wendell scheduled to testify on this panel.
Well, thank you, and good afternoon, Chairman Green and members of the Finance Committee. My name is Maurice Sampson. I am the Eastern Pennsylvania Director for Clean Water Action. I want to thank you for the opportunity to address you today. I'm here to offer testimony in support of Bill 210956 as the first step toward the establishment of a public bank, specifically a financing authority that, in my opinion, will provide capital in support of business enterprise, which will allow us to achieve goals which cannot be achieved by environmental policy alone. This includes financing for local businesses focused on renewable energy, reuse, recycling, upcycling, downcycling, and similar ventures in the emerging circular economy. My work for the environment spans a period of 50 years, including service to the city of Philadelphia as its first recycling coordinator in 1985 to 1987, and for many years, an independent consultant to business development in the arena of waste reduction and the circular economy. Over the years, I have frequently encountered businesses seeking financing for their ventures that are based on waste direct reduction. And because of that connection, they're misdirected from agencies or redirected by agencies like PIDC and PCDC to the streets department because their businesses are perceived as waste disposal. The banks who manage Philadelphia's assets have favored investment of public dollars in the fossil fuel industry infrastructure in the form of wells and pipelines to exploit and deliver fracked gas over renewable infrastructure, which is critical to the well-being of the planet. Business development in Philadelphia regarding renewable energy, waste reduction, the circular economy, in addition to green storm water infrastructure, is dominated by small, locally owned businesses. It is growing and it is poised for explosive growth if financing to match the social policy that these businesses reflect is made available. I get it. Private banks, in seeking to generate the most revenue for their shareholders, are going to put their investments in those ventures they perceive will reap the greatest return. A public bank, driven by public policy, will put our investments in sound business ventures that will return and reap the greatest public benefit. In my role as Eastern Pennsylvania Director for Clean Water Action, my focus has shifted from business to policy. I've come to realize what I now see as obvious. No matter how value or needed the social or environmental policy is, and regardless of the opportunity to create jobs and income, when it comes to competing against traditional financing targets, we lose every time. Establishing a public bank in Philadelphia will even the playing field and allow us to redirect our tax dollars into investments that will reap the greatest public benefit. I don't see the downside, and I encourage this committee to vote for this legislation for this Philadelphia City Council to adopt it immediately. Thank you for this opportunity.
Thank you, Mr. Sampson. We'll next hear from Ms. Lindsay, Ms. Lasker, and then Mr. Wendell.
Please pass Ms. Lindsay for a moment.
Okay. Ms. Lasker.
My name is Catherine Lasker, and I live in the Lawndale section of Northeast Philadelphia. I want to thank Councilmember Green and the other members of City Council for having this hearing and permitting me to present my point of view on the need for a Philadelphia Public Financing Authority. By presenting some of my experiences, I hope to illustrate some of the barriers to starting a business and the value that small business brings to the local community and even the regional economy in general. You're probably familiar with the negative forces that are moving against small business ownership, the displacement of mom and pop retail establishment by big box stores, the retirement of baby boomers who owned many of the small businesses and sometimes referred to as the silver tsunami, the break-ins and lootings that occurred during the recent social justice rallies, and of course the current crisis, the COVID-19 lockdown. Even though the federal government authorized large sums of money to help, we know much of that money did not reach its intended target. Once again, big banks interfered and dominated the situation and geared benefits away from small business. Many of these closings could have been averted if Philadelphia had an adequate and appropriate financing system to help small business. But the existing entities have not been able to override those forces. We need to find a new model to address the situation. I spent 38 years running a small business and am now retired. I relocated my small business from New York to Northeast Philadelphia in 1981. This means I brought New York dollars into Philadelphia, used them to purchase office equipment from local small business merchants, and created 7 new jobs. Obviously, my efforts were microscopic in relation to the broader economy. However, collectively, small business makes a big difference. But they can only make a difference if they exist, and therefore I am advocating that we help them to exist. When I first told some of the people around me that I was planning to start a small business, they all responded negatively, pointing out that I was only a woman and therefore could not know how to run a business. When I visited a loan officer at my local bank, his response was to refuse my request to fill out a loan application and asked where I ever got the idea of coming to a bank to get a business loan. He implied I had a foolish notion. I decided to stop wasting my time with these non-helpful people and just figure out how to finance my own startup. The important point is that at that time I had over 20 years working experience, which included teaching at a college, doing both clinical duties and medical research at a large hospital, and I had worked for 2 large international pharmaceutical corporations. My experiences had included both administrative duties and working as a bench scientist in pharmaceutical research. Also, when I was a teenager, I had worked as a when I was a teenager, I had worked as a bookkeeper for my father, who ran a small construction firm. I grew up around small business. None of these factors were considered. As a woman, I had an automatic rejection stigma attached to me. Similar, irrelevant, negative concepts are being used today to prevent many young people from starting or expanding a small business. The Philadelphia Public Finance Authority can offer small business a credit opportunity without concerns about earning high profits to satisfy stockholders and greedy executives. It could partner with local community banks and other entities to appropriately evaluate applicants and even advise and guide them into success. Economists have pointed out that small businesses produce more new jobs than big business. Creating new jobs in each of our local communities will go a long way into resolving Philadelphia's big poverty problem, the gun violence problem, the housing problem, and many others. No large commercial bank will ever fill such a role because they exist to only serve their executives and their stockholders. They take dollars out of the city economy with their enormous fees and high interest rate and leave us to scramble to resolve an overwhelming number of social problems. Here in Philadelphia, within our underserved communities, we have many capable, eager, budding entrepreneurs, but they need a hand up. You now have the opportunity to provide that help by providing fair credit opportunities to our underserved communities. Please remove the automatic rejection stigma and help them prosper. I urge the members to vote in favor of this bill. Thank you.
Thank you, Ms. Lasker, for your testimony. I believe we are joined by Margaret Lindsay. And also, I was remiss to not state for the record that Councilmember Maria Quino Sanchez joined us earlier as well and is a member of this committee.
Yes, hello. My name is Margaret Lindsay, and I am testifying on behalf of the Philadelphia Area Cooperative Alliance as a member of its policy committee and former board member. Cooperatives, as you may know, are businesses owned, controlled, and run by and for their members to realize their economic, social, and cultural needs. There are over 170 co-ops in the Philadelphia area. The Philadelphia Area Cooperative Alliance is comprised of member co-ops in the Philadelphia region. We are supporting many startup co-ops in Philly, some of which are being designed intentionally to support marginalized communities, such as immigrants and returning citizens and minority businesses. These cooperatives would benefit greatly from the type of lending that would be supported by a public bank. One of the biggest challenges for a co-op is getting the financing it needs to start up and develop. As we've heard earlier today, PIDC does not normally fund startups, but wants 2 years of existence in business. In addition, banks are limited in the amount they can lend to co-ops because of collateral requirements, personal guarantees, requirements from owners, and the concept of community-owned business is unfamiliar to many lenders. However, a public bill before us would promote investment in areas that specifically include cooperative development. For example, one of the purposes of the bill is to provide working capital and other capital needs for community economic development activities that specifically include cooperative business development. And the board of directors and the policy advisory board for the bank would also seek members who have experience in and a commitment to cooperative development. So, therefore, just in closing and getting right to the point, the bank, as you heard before, could provide much needed capital to startups and support community-centered cooperative businesses. It could be the difference between a co-op making it or not making it. So you have an exciting opportunity to invest public dollars into Philadelphia's communities through a public bank, which could in turn grow Philadelphia's community-rooted cooperative businesses. Thank you, and we look forward to your vote.
Thank you, Ms. Lindsay. Greg Wendell, I believe, is the last witness on this panel. Please state your name for the record and then proceed with your testimony.
Good afternoon, council members. My name is Greg Wendell. I'm the representative for the Philadelphia Democratic Socialists of America on the Philadelphia Public Banking Coalition. More importantly, I'm a proud graduate of our Philadelphia public schools. I was born and raised in this city, and when I have kids, I want to send them to our neighborhood public schools. And that's why I urge you to pass this bill creating a public bank in Philadelphia, so that we can build a safe and modern school in every neighborhood. This is just one of many things that a public bank could do, which the PIDC is not already doing. As a student and later as a reporter for the Philadelphia Public School Notebook, I saw firsthand the toxic conditions in our school buildings. When I was a student at Masterman, the most privileged school in the city, the 4th and 5th floors were suddenly shut down after a maintenance worker found exposed asbestos. They never determined how long it was exposed for before it was discovered. Fast forward to today, and that school community is still struggling to ensure their students have safe air to breathe. If it continues to happen at Masterman, despite all that community's resources, we can be sure that it is happening almost everywhere, whether we see it on the news or not. As council members, I'm sure you already know of the toxic conditions that are even more common at schools in high poverty neighborhoods of color throughout our city. After hard fights from parents and staff, the school district is rebuilding Cassidy and TM Pierce. After hard fights from parents and staff, 12 schools have had to shut down due to exposed asbestos since the fall of 2019. Parents should not have to fight for safe and modern school buildings. Our city should build them. The school district's facilities condition assessment, completed in 2016, found that the school district would need to issue $3.5 billion in bonds over the next 5 years to start gradually repairing our schools. Well, it's been 5 years, and we've only been able to issue about $1 billion of the $3.5 billion that our students need. At the current rate of spending, our schools continue to deteriorate. There's a reason for this. In order to improve their credit rating and decrease the millions in interest paid on these bonds, the school district has to keep its annual debt service payments below 10% of its operating budget, according to Ori Monson, the CFO for the school district. The numbers are clear. Our school district cannot do it alone. I appreciate the work of the Philadelphia Industrial Development Corporation, but it is not providing any meaningful amount of funding for our public schools. That's not its mission. Our students and staff urgently need the city to step in. I understand. But by creating a public bank, it's an opportunity to get around those constraints and build a source of funding that can address this crisis. With a public lending institution, we can finally give over 100,000 public school students and their families what every child deserves: a safe and modern school in every neighborhood across our city. I want to thank Councilmember Green for introducing this bill and every council member on the Finance Committee for taking the time to listen today. Together, we can take this opportunity to build a brighter future for the children of this city, for the families who depend on our public schools, and for the communities that our schools serve. I look forward to building that future together.
Thank you, Mr. Wendell, for your testimony. Are there any questions for members of this panel? All right.
Mr. Chair,
Yes.
I just wanted to thank the panel. And there's a number of people who are on here who've been working on this issue for many, many years. And I just want to thank them for their work and appreciate the work of everybody on here, and especially Greg Wendell. Thank you.
Thank you, Councilmember
For more than
Gill.
35 years, as you've heard, we really have been known as a food bank providing access to food. But this year we really redoubled our efforts so people who are hungry comfort in the form of healthier and more
Dom's
nutritious
microphone's
food,
open.
serving up a variety of ingredients.
Thank you so much. Are there any other comments to members of this panel? Seeing and hearing none. Are there any other individuals who are here that would like to testify this afternoon, whose name we have failed to call, and would like to offer testimony on this bill that's being considered today? Okay, seeing and hearing none, I want to thank all of the witnesses that are here Thank you for your participation today, for all the witnesses that participated in today's hearing. Now, we had a lot of information that was very detailed in a lot of ways. I want to thank you for your time and your passion and your energy and perspective in providing your information in your testimony. We definitely value your opinions. I now invite all panels of witnesses to please disconnect from the meeting before we go into our public meeting. We will now pause the proceedings briefly as multiple participants leave the hearing. Okay, this concludes the public hearing of the Finance Committee. We'll now go into a public meeting to consider action be taken on the bill before the committee today. We'll now convene the public meeting. Mr. Inez, will you please call the roll to take attendance? Members that are in attendance, please indicate that you are present when your name is called. Also, please say a few brief words when responding so that your image will be displayed on screen when you speak.
Councilmember Cindy Bass.
Good afternoon, Mr. Chairman and colleagues. Thank you very much. Mr. Chairman, thank you so much for this hearing. It was so informative, and as a member of the committee and as a co-sponsor on the legislation, this was a really good hearing. So thank you very much.
Councilmember Alan Dom.
Thank you, Mr. Chair. I am present. Thank you.
Councilmember Helen Gim.
I am present.
Councilmember Curtis Jones Jr.
Mr. Chairman, members of the committee, very informative, lively discussion. I am present.
Councilmember David O.
Good afternoon, Chairman and colleagues. I am present.
Councilmember Maria Quinones Sanchez.
Good afternoon, Mr. Chair. Thank you to the members of the committee. I look forward to moving this forward.
Member Mark Squilla.
Thank you, Mr. Chair and colleagues, and thank you to everyone who had testified. Very good information and informative. Present.
Chair Derek Green.
I am present. I just want to take a moment, personal privilege, to thank all of the witnesses and panels, but also want to thank my colleagues for participating in this hearing. I know it was a lot of information, quite detailed, and got into a lot of different perspectives regarding this issue, but I thank all of you for your participation and your questions regarding today's bill and today's conversation. We will now go into our public meeting. I now recognize Councilmember Squilla for a motion on the amendment to bill number 210956.
Thank you, Mr. Chair. I offer an amendment to bill number 210956. A copy of the amendment has been circulated to all members of the committee. I move that the amendment to bill number 210956 be approved.
Second.
Second.
It has been moved and properly seconded by Councilmember Jones that the amendment to bill number 210956 be approved. All those in favor of the motion will signify by saying aye.
Aye. Aye.
Those opposed? The ayes have it, and the motion carries. An amendment to bill number 210956 has been approved. I now recognize Councilmember Squilla for a motion on bill number 210956 as amended.
Thank you, Mr. Chair. I move the bill number 210956 as amended be reported from this committee with a favorable recommendation, and further move that the rules of council be suspended as to permit the first reading of this bill at the next session of council.
Second.
It has been moved and properly seconded by Councilmember Bass that bill number 210956 as amended be reported from this committee with a favorable recommendation, and further move that the rules of council be suspended to permit first reading of this bill at the next session of council. All those in favor of the motion will signify by saying aye.
Aye.
Aye. Aye.
Those opposed? The ayes have it, and the motion carries. Thank you all very much. This concludes the business before the Committee on Finance for today. I want to thank all of my colleagues and members of this committee for your attendance. I know it's been a very long hearing, and for all the witnesses and observers, thank you for your participation today, and have a great day and have a happy holiday season. Thank you so much.
Thank you, Mr. Chairman.
Thank you, Mr. Chair.
All right.
Thank you, Mr. Chair. Great job.
Thank you all.